Bhavesh?
As
Bhavesh,
I think meeting has started.
so, starting. Okay.
Yeah, where Saraj bhai आवाज आएगा मारो?
Yeah. Yes.
I think 4 o'clock meeting automatically starts. So.
Okay. No issue.
So while participants are still coming in, Kunal bhai, if you want to just test your PPT or presentation before we formally start.
Once Kunal bhai taste his PPT, then we can start. Correct? Yeah. Perfect. Shreyas, you are on mute. Yes.
Kunal bhai, just try moving the slides up and down, couple of slides.
Okay.
Yeah.
Fine. Okay. Shall we start?
So Kunal bhai, you can stop the screen sharing for now. We'll formally start this. Sharad bhai, over to you. Thank you.
Yeah. Thank you. Yeah. Good evening, everyone. Welcome to this webinar. Before we start, I request all of you to rise for motto.
सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता
Good evening once again, everyone. So today's topic is NBFCs and major key amendments and recent amendments in NBFC regulations, as well as various development that is taken into the field of Fintech and auditors' duty, responsibility vis-a-vis. We at BCSC, whenever we have a topic of NBFC, we always first remember Bhavesh bhai. Now, and everyone knows how authority he is as far as NBFC is concerned. So we welcome Bhavesh bhai VORA, CA. Along with him.
Thank you, Saraj bhai.
Yeah. Along with him, we have got another learned speaker, CA KUNAL MEHTA. Both of them will take various issues and side by side. Now, before I request them to take the charge, I request CA Aman Khandelwal to formally introduce both the speakers. Aman, please.
Good evening, one and all. It gives me immense pleasure to introduce CA Bhavesh VORA. So Bhavesh VORA is a practicing chartered accountant with over 30 years of rich experience, having specialization in providing end-to-end consultancy services to capital market consultancy, NBFC, PMS, stockbrokers, regulations. Currently, he is serving as a senior partner at BY and Associates Chartered Accountants based in Mumbai. He also holds immense interest in academia. He is a regular speaker at various seminars, lectures, and forums, including organizations like ICI, BCS, and CTC. He has delivered lectures to organizations of the likes of RBI, BSC, FIMDA, ANMI, BSE Brokers Forum, etc. He has co-authored guidance note on audit of accounts of members of stock exchange, along with internal audit of stockbroker and next generation CS Getting Future Ready, published by ICI, and also co-authored BCS prestigious publication NBFC Tritsi. Presently, he holds key positions as President of Investor Education Welfare Association, a SEBI recognized association. He is an external expert in the Regulatory and Oversight Committee of MSE, that is Metropolitan Stock Exchange of India. He is the trustee of BSE IPF, that is Bombay Stock Exchange Limited Investor Protection Fund. He is also a member of various committees of the bodies like WIRC of ICI, BCS, and CTC. In the past, he has held key positions of President of CTC. He was a co-member of Professional Development Committee of WIRC of ICI. He was a visiting faculty at Wellinger Institute of Management, Development and Research. Member of subgroup of Financial Reporting and Review Board, that is FRRB of ICI. He is also an avid reader. His hobbies include reading management and spiritual books, and he also enjoys imparting education, traveling to new destinations. With this introduction, I once again welcome you, Bhavesh sir. Now, I would like to give a brief introduction about our second speaker of the day, KUNAL sir. CA KUNAL MEHTA manages the Nbfc and Fintech division at Basilstone Consulting. He has extensively worked in the domain of strategic, transactional, and operational advisory for the non-banking industry, including advising large Nbfcs, core investment companies, housing finance companies, and assisting startups, including peer-to-peer lending platforms, digital lending, neobanks, and fintech entities. Mr. Mehta has also assisted a large group of companies in the financial services sector to transition to the Ind AS regime, and has also advised on specific Ind AS related matters. He actively participates in research activities across various knowledge areas pertaining to International Financial Services Center, fintech and digital lending platforms, FEMA, Ind AS, IFRS, and has also co-authored the publication of Basilstone Consulting, that is Core Investment Companies, a prologue, published in June 2021. With this brief introduction, I once again welcome Kunal ji. And as it is a virtual seminar, we would like to offer the speakers a virtual memento. Yeah, 1 minute.
Correct.
One minute. And also on behalf of the speakers, BCSC contributes 500 rupees to the ICI Benevolent Fund on behalf of the speakers. And without taking more time, And I would like the speakers to take the charge and begin with the session.
Shall we start?
Yes,
Yeah,
sure.
yeah.
Hello.
Yes, bye. Go ahead.
Shall we start?
Yeah.
Yes.
Can you hear voice by?
Vishal, everybody is able to hear? Can
Yes,
we
yes,
start?
Yes, sir.
Am I audible to everybody?
Yes. Voice by, again, you are on mute. You are on mute, by. Yeah, please. Thank you.
No, am I audible now?
Yes.
May I request Kunal to share the screen? Vishal, you will have to, enable Kunal to share the screen, Vishal or somebody.
Shreyas, please do the.
Yes, Kunal can share now.
So am I audible to everybody?
Yes, sir.
Yes.
Good afternoon. I'm sure everybody has a nice cup of tea and, sitting for a maybe very complex subject on a NBFC. But let me promise you that we will make it really simple and something really easy to really digest on Saturday evening. So at the outset, let me thank our dear convener Vishal, Aman, Sarad Bhai, and all other distinguished, committee members of Borivali Study Circle, and all my lovely participants, which I can see about 153 in numbers. So thank you everybody. Because of you, we are here to really learn the subject and tell you something about how this field has been changing. Thank you, Sarad Bhai. You give a very nice introduction. Aman also, you talk a lot. Of course, I could hear very little. Thank you, all of you, for such a wonderful introduction to me. When we have to talk at Borivali Study Circle, for me, is a home calling like experience. So whenever Borivali Study Circle calls me that Bhavesh Bhai, you have to speak on the subject. I remember Sarad Bhai, in a COVID, we spoke something on a very different subject. Okay, maybe on a wealth management and health management or something like that.
Yeah, it was a good
Uh,
panel discussion.
Yeah, it was a good panel discussion. One of the RRC, we spoke on a practice management, and once I think I did speak on the mergers of chartered accountancy firms, pain and gain, and one or two times on NBFC. So Borivali Study Circle always tries me with a different, as a captain, test my bowling abilities, batting abilities, fielding abilities, and sometimes asking me to sit on the fence. But let me tell you, when the call comes from Borivali Study Circle, I am really, I don't think that I need to really think of saying yes or no. Only the date is concerned, and whatever topics they call me, I am always there. So that is my love for this study circle, and I know this study circle is bigger than many of the branches in institute, and always been ranking, as a number one study circle in WIC region. So congratulations to all the committee members and all the torchbearer of this study circle to make really a wonderful, exposition of the teamwork which you have been doing. When coming to today's topic, okay, NBFC, recent development, Fintech, auditor directions, so whenever we talk on this subject, there are lots to say. I remember 10 years back when we were speaking on this subject, even 2 sessions would have been enough to make you masters of NBFC. So if you start speaking at 10 o'clock, by 1 o'clock, you are through, and anybody can say, okay, I know everything on NBFC. Today, I would say at least 3 days will not be enough to speak on NBFC. This is how the thing have been developed in last 10 years. So this is the entire journey I would like to tell you, that how and why this has happened. Let me tell you, maybe 10 years down the line, maybe something in 2009-10, if you really wanted a loan, or I am sure everybody would have tried.
We have lost.
And put so many Xerox certified copies and
There seems to be some net
So,
issue.
lots of
Bhavesh bhai,
I'm not audible.
yeah, now intermittently you are not audible. Is there any some net issue or let's put off the switch off the video. At least
Yeah, I will switch off the
no, we will switch off. Let's see.
video.
Everybody
So
would like
that,
to see.
yeah. Am I audible and visible now, friends?
Yeah. Bhavesh.
Okay,
Go
thank
ahead.
you. Thank you. So friends, maybe I was just telling 10 years back, this was a situation where if you really wanted a loan, it would take 2 to 3 months, after a rigorous paperwork. But today things have changed. Today, when we are talking to the NBFC, they are telling us that we would like to have, we would like to work, we can roll out the loan in 3 minutes. So this is a change from 3 months taking a loan. We have now moved to 3 minutes. And what are the challenges? How it has happened? What is likely to now happen? All that in time to come we will discuss. But one thing is very I'm very much certain that there is a paradigm shift in the entire NBFC regime. The way they are working, the nature of the loans, the activities, the participant in the NBFCs. Earlier, the NBFC were seen only as a money lending activities. Okay, you take the only the rich person would give the loans, all their stuffs. I think that has been changed, and you will be surprised that even maybe in somewhere in 1999 there were about 40,000 NBFCs prior to 1999. Today we are talking about 9,000 odd NBFCs. Now, why this has happened? And maybe 4 5 years down the line, it was maybe 4 5 years prior, maybe 2016-17, we had about 14,000 NBFCs. So at one hand, the number of NBFCs licenses are reducing. At other hand, the volume in which they are been working, that is increasing. So this shows that the NBFC, which was not very significant, has suddenly playing a very significant role in the economy. If you remember, friends, many of you who are above 45 or above 40 here sitting as a participant, they will realize our curriculum also NBFC was never there as a part of, it was like a when we were been studying chartered accountancy. Now, chapter on CA curriculum also. There is a English, there is a significance which has been very big significance of these NBFCs. Not only the significance has increased, the complexity also has increased along with this significance. Many of the large promoters, many of the large financial conglomerate, they want NBFC as a part of their group company. So the nature of activity has changed, profiling has been changed, the expectation of the stakeholder also has been changed. And now today, you ask any practitioner, maybe company secretary, chartered account, CA firms, advocate firms, law firms, everybody, there is something very important, segment exists, which is known as NBFC. So why suddenly this has happened, and why suddenly these NBFCs are being seeing a very different color, and why everybody want NBFC as a group, and why sudden jump in a significant or in the importance of NBFC, and one should definitely know that the topic which was not very important or the segment which was not very important, okay, why that suddenly it has become so important. So let me just tell you about 2 3 4 5 things why it has become very very important. Friends, there is lots of new financial products which has been added, okay, in last 5 to 8 years. This has also made NBFC a very important part. And not only the new financial and innovative financial product has been added, apart from that, the all financial product and financial systems are getting integrated. So that we will discuss, over maybe 2.5 hour talk, that how this integration has helped NBFC to go beyond. Second is technology and smartphones. So this is a very big movement, and needless to say, in the smartphone and internet, India is almost the second or third country in the world. So the use of technology, use of smartphones, I think has played a very big role in this, the NBFC, which is going to a different level. Third important part of startups, fintechs, and the newer needs of our young generations. And I know many of you are also aware that India may be ranking number third country for startups. Fintech also maybe second and third country in the world. And the needs of the youngsters and needs of the businessmen are also been changing. They want the money at just click of the button. And fourth important thing is that earlier when in our days we knew saving was only way of becoming rich. Today, I think people have moved that apart from saving, there is something like investment, which one will have to see. And apart from investment, even one will have to borrow and they can still make rich. So the India is moving from a saving economy to investment and borrowing economy, which also will make a big difference in NBFC in time to come. And the fifth and very important is the demography of India. Our country, if you know, friends, it has been said that by 2029, India will be the youngest country. Okay, and more than 50% of our population is, more than 65% of our population is, below 29 to 30 years of age. So we will see that lots of youngsters, they want the smartphones, the quick money, the technology, startups ideas, and newer needs. All those things, friends, putting together has given the lots of impetus to the growth of NBFC. And to my understanding, this we will going to see very different pictures of NBFC. NBFC definitely will remain. There was a talk in 2014 with Reserve Bank of India whether in India do we require NBFC, because banks have already gone to the nook and corners of India. You find in somewhere in Himalayas also you find a bank branch, and somewhere near seashore in a remote area also you find a bank branch. So when banking has gone in every nook and corner of India, do we really need the NBFC going to public or not? So there were lots of debate, friends, in 2014, and almost for 10 months or about 10 months, RBI stopped accepting any new licenses on this year, thinking that whether we should stop NBFC at all, or we should give NBFC, or we can give registration of NBFC with some new ideas and with in some new avatar. But in 2014, again, somewhere in October, they started. At that time, we were of the opinion that now NBFC will not see light of the day in India. But now things have changed, friends, and with the enforcement, I think things are different. And when we are talking of 2000, let me just tell you the history of this NBFC. Somewhere in 1999, where the NBFC which was getting registered. So in 1999, the first time the Act came to regulate the NBFCs, and this came because of the CR Bansali CRB scam, where so many depositor, they were being duped by some of the NBFC companies. So in 1999, some loose, regulations came for NBFC. Thereafter, in 2000, there were, as I told you, more than 45,000 NBFC prior to 1999. Today, the NBFCs are about 9,000 and odd. There in 2007, first time RBI, I know many of you may be saying that 2008 was the year when Lehman Brothers came, in America, which in the USA, which opened. Just prior to that, in 2007, RBI came with little stricter regulations of NBFC, bifurcating the large NBFC above 100 crores and the smaller NBFCs, below 100 crores, and started regulating it separately. So from 2007, again, I would say the real regulatory regime started this in 2007. Thereafter, there was, maybe very regulations. Again, in 2016, the entire regulation got revamped, and the new regulations came where the size of 100 crores was been shifted to 500 crores. So in 2016, the regulations which was being revamped, the earlier regulation which got revamped was reinstated, saying that NBFCs which are above 500 crore size will be separately regulated. When I'm talking about size, I'm talking about the asset size. and not the net worth or a income. And the NBFCs which are below 500 will be will be regulated separately. So 2016, lots of regulations came, and our auditor direction also, which was there in 2007, also got revamped. And the new regulations for auditors also came in 2016. Thereafter, we have found, and if you see, after this, there was a ILFS came or a DHFS came, and lots of issues came thereafter. RBI started seeing the entire segment of NBFCs very closely. Okay, and with of returns, a lots of reporting, MIS, all that has been started in the entire NBFC piece. This is the journey from 1999 till today, and last 2 years were really the year of lots of activities from the regulators' point of view. So lots of circular also came, lots of new thing also has been changed, and Kunal will definitely take us through the the separate what you say the regulatory, which is now moving from 500 crores to scale based regulation, which will now move from 500 crores to 1000 crores. See, in last about from 2017 till today, almost 5 years, we have about 80 circulars which has come, okay, from RBI governing this entire NBFC piece. But in 2017 to 2022, out of 80 circulars, 45 circular has come just in 2 years. So in a COVID era, we have about 45 circulars. So this shows that how RBI is been looking at it. There are some papers of digital lending which has come last year. Supervision, all breaking innovations which RBI want to bring. We will have to still see how this digital lending regulations is going to come in, maybe 2, 3, 4 months of time. But let me tell you, the entire NBFC, which we were seeing in 1999, then 2016, then 2019, and what we are going to see in 2022-23 is going to be a change with 720-degree or 360-degree changes, which we will see. So friends, these are what about the brief introduction of how the NBFC has really moved from time to time, and now as on today, I think it has become very important, pivotal, and part of the Indian economy. And I don't think so any regulator will now think really that whether in India NBFC is required or not required. We'll see how this move, and some of the NBFC friends today are larger than the smaller banks. So we'll have to see how this is going to move in next 4-5 years time. So this is a brief introduction. Now coming to the subject proper, what we have decided, friends, as I told you, there are lots of material which we can go on discussing for 3 days on NBFC. But looking at and talking to the convener, we understood that we will restrict ourselves to something which is very important to all of us, who are or routine practice, and how we are really going to help the CPs. Number one. Number two, fintech. What is this fintech and how it is going to happen?
Bhavesh bhai, sorry, you have to switch off your video because the voice is cracking.
Yeah.
If you can switch off your video, that will be better, I think. Please.
Yeah. Now it is clear.
Yeah.
Okay. So now we will have to see that then we will definitely see the fintech, how it is going to really happen. Then we'll discuss about auditor directions, that what is our obligations from RBI, from the institute, and from MCA point of view, what are our obligations, how we can fulfill those obligations. And between me and Kunal, I will ask Kunal now to take it over, with the introduction part of the NBFCs, and maybe interchangeably we'll go on discussing. So friend, this is from my side on introduction. I'm definitely here for all 2.5 hours, and whenever you have questions, we will definitely take all your questions at the end of the sessions. So now, thank you everybody. Now Kunal is over to you. Thank you.
Thank you, Bhavesh bhai. So the whole idea of NBFC, as Bhavesh bhai pointed out to us, the flow of how the regulations have moved from a light touch regulation that the regulator was intending to only regulate the shadow banking aspects of the NBFC, has now moved to more operational and shall we say, day-to-day affairs of the NBFC are being regulated by RBI. To understand what exactly does RBI think when it, at a macro level understands or looks after an NBFC, I think it is very important that we understand how do we identify an NBFC, because it is very essential, to understand how RBI looks at a company or an entity that gets classified as an NBFC and why that regulation happens. So, as an introduction, maybe. Yeah. So, what is an NBFC? RBI's Chapter 3B of RBI Act 1934 is what governs the NBFC per se in the entire industry. Now, when I say NBFC does not only mean the ones that are registered with RBI, but it also includes all entities that are basically into shares, stocks, bonds, debentures, loans, etc. How that entire regulatory gamut works between, say, a RBI regulated NBFC and a stock broker, we will examine. To identify an NBFC, whether it is, a normal firstly, it has to be a company and a financial institution. A financial institution is an entity which conducts the business of acquisition of shares, stocks, bonds, marketable securities, or it engages into lending activities. Plus, it has to be a company. Any other form of entity is not regulated by RBI. RBI basically regulates only cooperatives, banks, and companies. So it has restricted that to the company format. Coming to the principal business criteria. So on 8th April 1999, RBI had issued a press release which stated how we are going to look at a company and identify whether this company qualifies to be an NBFC or no. That press release, which was later ratified by a notification in October 2006, states that financial assets of any company, if that total exceeds 50% or more of total assets, and the important word here is and, income from such financial assets exceeds to 50% of total income, then it is considered to be carrying on the business of NBFC. Now everybody here in the panel or in the participants have at some point in time read through this, especially after the Caro 2016's Clause 16 reporting has come in. Every auditor has more or less understood this, but I think let's make this session a little more interactive and try and find out the nitty-gritties of principal business criteria. So what I have done is I have set up a few examples. Are they visible on the screen?
Yes, sir.
Yeah.
So I have set up a few examples, and I would like the participants to respond on the chat on what they think, whether this is an NBFC or not an NBFC, on the basis of the principal business criteria. Okay, so I think so most of the participants are leaning towards saying that it is not an NBFC. It is correct to an extent that, investment in property, even though it is an investment, it is in non-financial asset, and therefore it is considered, it is not considered as an NBFC. So moving on to the second example. Here, what do the participants here feel, whether this is an NBFC or not an NBFC? Okay. So here as well, participants are saying they are not an NBFC. I, as an auditor, if I was here, I would hold a more conservative view and go ahead stating that, although technically this is not an NBFC, it shows the colors of an NBFC simply because it has given interest-free loans. Now, just because an asset which cannot is not bearing interest today does not mean it will not be bearing interest tomorrow. So as an auditor, I will tread on such balance sheets cautiously on making an opinion on my audit report. Moving to, I think so, example 3. Now here there is no profit or loss, but there is assets that are there which are financial in nature. Now, in this case, whether it will still be considered as an NBFC or no? Are we? Let's participants. I would really appreciate if you all put other thought out, even though if it is correct or incorrect. See, the idea is we are here to learn. All right. So in this case, even though both the criteria is not met, but because there is no income, the conservative position that is taken generally is that if both the conditions are required to be fulfilled, but if one of them cannot be fulfilled because there is no income, we ignore that and we only look at one of the two conditions. So this is one of the conservative views that we have taken, and therefore qualifying this as an NBFC. Moving to the next example, does this qualify as an NBFC? Okay, I'll see a lot of participants stating yes, that this is an NBFC. I would like to draw their attention to one minor detail, that this is not ABC Private Limited, this is ABC. So to become an NBFC, it has to be a company. If it is not a company, it cannot be an NBFC. Moving to example 5. In this
now everybody is seeing the ABC Private Limited.
So in this case, what is the feeling like? Okay, so yes, purely looking at it from a principal business criteria, yes, this is an NBFC. I think Mr. Nirav there said that this will qualify for a core investment company. Sir, I would like to draw something to you that these are loans, not investments. Of course, we'll discuss on the core investment company aspects at a later stage. But loans to related parties within the group also qualify as financial assets is what we were trying to inference here. Yes. So with that being said, so this is how RBI looks at it from a principal business criteria perspective. The press release of 1999 was formulated with the circumstances of that case, and because of that, the dynamic business models that have come up, the different kinds of instruments that have come up, investment opportunities, asset classes that have been formulated, distinction, applying that same criteria in today's time as an auditor, I think we need to tread with uh, you know substance over form when we go ahead with our reporting duties. Coming to my earlier point of what is a financial company, exemptions, etc. Now, even if you are a stockbroker, you are technically an NBFC. Even if you are an insurance company, you are technically an NBFC. You are regulated by Chapter 3B of the Reserve Bank of India Act. Per se, if the exemption given by RBI was not available. So Chapter 3B of RBI Act in a way acts as the overarching regulatory provision for all NBFCs in India. Although some are regulated by RBI, some are regulated by SEBI, some are regulated by IDA, and to avoid dual regulation, RBI has given exemptions from getting registered with itself. Moving on to the next important aspect of NBFC is the types. Now,
So, Kunal, only one thing, friends, here. When Kunal did talk about this 1999 circular, and this circular from that day, people were of the opinion that this should be changed, whether it should be 75% or not. Let me just tell you how the RBI look at. There are some confusion still prevail that if I have a company where the asset is below 2 crores, whether this will be applicable, answer will still be yes, or even with 50 lakhs, answer will be yes. In our experience, friends, people try to work around when they come across this problem of NBFC, and they try to, don't go to RBI. So our request to all of you that whenever you found that problem that because of some activity has not happened in the company, some operating activity which has not happened in the company, you can definitely approach RBI, because it's not what RBI looks at is your intent. Okay, though as an auditor, last year balance sheet is very important for us, whether you are deemed NBFC or not. But if you have become deemed NBFC because for whatever reason your operating income were very low, okay, then you may definitely write to RBI, and RBI definitely is giving relaxation, for the same. So I think we should not just try to work around that how to come out of this problem. Rather than if it's a 1 year, then you may approach RBI and seek their guidance also. Yeah, Kunal, you can continue.
yeah, so as rightly said by Bhavesh Bhai, that the view of RBI is more to do from an intent perspective than getting into the comma full stop of things. And if we go ahead with an action plan stating how we are going to take care of things, then they are open to listening to us. That is what we have been experiencing since we've been in this industry. Moving to back to the slides. I was on the types of NBFCs. So the types of NBFCs, basically RBI has classified them into 3 categories, broad categories, on the basis of activity, on the basis of size, and on the basis of deposit acceptance. I'll quickly run you all through each type. NBFC ICC is one sort of a residuary type where all investment and credit activities are considered part of it. How HFC means housing finance companies, which specifically focus on financing housing projects and purchase of housing, basically real estate exposure. MFI are into microfinance institutions which provide microfinance loans, which means financing to households that have annual income that are much lower than those prescribed. Currently, that has been amended to 3 lakh rupees. The other is NBFC factors, which are engaged into factoring business. There is a thin line of difference between factoring and bill discounting, which we will get into a discussion if time permits. The others are more to do from the government side of things, which is NBFC, IFC, and IDF. Both are related to infrastructure financing and raising funds for such infrastructure projects. CIC NDSI is basically core investment company, which acts as a group company, group holding company, which holds all the assets in the nature of shares of all the operating companies. Of course, Bhavesh Bhai and we will get into a CIC NDSI at length in the later discussion. MGC is mortgage guarantee companies. NOF, HC are non-operating financial holding companies, which are basically like CIC but for banks and bank groups. NBFC P2P is a recent addition to the type of NBFC. Not really recent, but 2016-17 is when the papers came in. Peer-to-peer lending platforms are basically matchmaking platforms for individuals with surplus money to individuals who need money. NBFC AA means account aggregators, which basically collate all account information from all financial institutions and make them available to you for use and disposal. Moving on the basis of size, currently both the NBFCs are classified as systemically important, which is 500 crores or more in terms of total assets, and non-systemically important means less than 500 crores. Now, when we see that 500 crores, it is not qua company, but we have to observe it qua the group. So if I have 5 NBFCs, each having the total asset size of 110 crores, then all the 5 companies will be considered systemically important NBFCs and regulated as if it is a 660 crore company or a 550 crore company. Deposit acceptance is, again, since I think so 2005-6, RBI has not allowed any entity as such to accept deposits or new deposit accepting companies, and slowly these deposit accepting companies are also being wound up. The deposit accepting activities are being wound up, and of course there are other non-deposit taking companies, which are the generic NBFCs that we have. Now, on 22nd October 22 is when the scale-based regulation kicks into picture, where these classifications that currently exist will become redundant. Of course, we'll discuss them in a very much detail on what is the base layer, what is the middle layer and upper layer. And what RBI has tried to do is not classify them on the basis of merely activity or size, but classifying them on a basis of combination of activity and size, along with the fact of whether they are deposit accepting or not. Yeah. Now, this I think so Bhavesh Bhai has already covered. This is a trend of 31st January 22 on what the total NBFCs in India look like. As we've spoken, that the total NBFCs have reduced from a substantial sum to approximately 9,500 as on 31st January 2022, of which those which are less than 100 crore are 8,500. So there are only 1,000 NBFCs out of 9,500 NBFCs that are more than 100 crores in terms of total size, and only 900 something NBFCs which are more than 100 crores, of which only 316 are more than 500 crores. Of course, for 49, the deposit accepting NBFCs are going to slowly the number is going to go down, because what we've been seeing is excessive regulation is making the deposit accepting business financially challenging in terms of project and product viability. With this, I think so we need to move to a more approach of how, as an NBFC, if I am in India and I want to start an NBFC, how do we proceed with it? Where do I do? What do I do? What are the requirements and how that is to be done? I think so. For that, I will request Bhavesh Bhai to initiate on the registration and NBFC aspects of it. The regulatory aspects, of course, limit to something that is from minimum requirement of 10 crores, and type 1 versus type 2. Uh, Type 1 NBFC is something where you cannot accept public funds and cannot have customer interface. I think this requires more deliberation. So type 1 and type 2 NBFCs are two types of NBFCs on the basis of which RBI looks at any NBFC application. Type 1 NBFCs are basically, in simple terms, I am doing investment activity with my own funds. That is what type 1 NBFC means, which means there are no borrowings and there are no lending. If you borrow but don't lend, you are still a type 2 NBFC. If you don't borrow but conduct lending activities, you are still type 2 NBFC. So to be considered as a type 1 NBFC, you are prohibited to have both borrowings as well as lending activity. In the registration aspect of things, of course, the processing is now happening at the Mumbai office, and RBI's look or the approach towards a probable entrant coming into the NBFC space has moved from checklist or tick mark or document based review of the application to a more quality, how that business is going to be scalable, going to add value, and how it is unique from existing products, whether it brings additional competition to the market, are all the aspects that are going to be considered from the are really considered as of now in the NBFC application process. As we all know that under the consolidated FDI policy of 2020 and some amendment few years back, 100% FDI is now allowed for NBFCs and the other financial services sector without any minimum capitalization under FEMA. Of course, there is capital requirements prescribed by RBI, but FEMA has not prescribed any minimum capitalization norms. And the other approach to probably commencing a business of NBFC is to go through the change of control, or that is change in shareholding and directorship, acquiring an existing NBFC. Now, acquiring an NBFC is a process where regulatorily you are required to obtain a prior written approval of RBI, and only when RBI blesses you, the buyer, as well as the sources of funds, is when they give an approval and the transaction takes place. So RBI has sufficient mechanisms to have withhold cases which have happened in the past, where backdoor entries into NBFCs were happening, which was stopped. So with that, I think so I would like Bhavesh Bhai to come in and help us, guide us on the macro aspects of these.
Oh, Kunal, so friends, I think let's discuss. These are two important parts which is touching many of the professionals who have been listening to this. I have seen many professionals who would like to give the professional services for making the NBFC application, and we have seen many rejections or delays happening because of this application. So let me just tell you what practically we are all doing a mistake, and applications are getting rejected, and what RBI is. Okay, so please understand here that when we are making the application for registration, as Kunal rightly said, first of all, there is no clarity that we are type 1, we are type 2, and we are NBFC factor, NBFC ICC, NBFC microfinance. So many times our experienced friends, the client himself, when they come, they are not clear that what they really want to do. We'll have to really ask them that what is type 1. I have seen where they have got a type 1 license and they realize that we have type 2 license because they were not knowing that what they want to do. First and foremost, if anybody here listening are practicing in an NBFC registration regime, I think please understand and get a written mandate from a client that what exactly they want to do, and make them ask them 2 times, because sometimes client also are have very blur or very provisional ideas that what they want to do. Once you are very clear that okay, this is been the idea of a client is not only the filling of the form. So many of our professional brother feels that okay, these are the forms available on the website. So take the form, fill up the form, and uh, attach some of the papers and give it to RBI. I think that is not what RBI is looking, and that's why the delay happens and lots of question answer happen. Please understand that whenever you are making an application, 2 3 things are very important, which you have to see first with the RBI says. And number one is what are the credentials and capability of a promoters, because RBI normally say that what are the capabilities of the promoters, what are the credentials, so they do their KYC. So we also before, and we don't want any question from RBI. So if anybody of you are doing this application, you need to first self satisfy yourself that the credentials are very good, there are no penalties, or there are no adjudication, no court cases, no litigation. Of course there are litigations, then you have the entire summary of litigations, that what can be the result, which or what will be the
Bhavesh bhai, your voice is cracking.
yes, to see your capability. In cases
Bhavesh bhai,
there is no
Bhavesh bhai,
NBFC experience, the
hello, Bhavesh bhai.
does not- yeah. So if there are no NBFC
Ba-
experience, okay, the RBI is yeah, Sarad bhai?
Yeah, your voice is cracking. So,
Yeah, I think I have to keep my video off.
please.
Okay. So in that case, it is very clear that RBI is been looking at this type of cases where you are very good, your KYC is very good, but you are not capable of running the business. Other thing, friends, we have observed here is that many promoters have their group companies, and when we talk about the group companies, when you give the application to RBI, you have to see the group companies of directors, group company of the applicant company, group company of the shareholders, and many other things. That list itself is not sufficient to the RBI, and lots of queries start thereafter. And when the RBI calls for the list of those group companies, they also see whether in any of the group company, whether there was any of deemed NBFC sort of scenario or not. I think that has to be checked by ourselves first rather than it goes to RBI. These are the few word of caution to all of you before you make an application to RBI. That have you yourself checked, and you also will have to see that apart from that, RBI asks something about business plan. We have seen people just cut copy the business plan, and that also is not sufficient. You will have to talk to the promoters and the directors that what is the business plan. You have to give the RBI a good case that RBI, you have to give the application in such a way that RBI finds very difficult to reject the application or return the applications. So that also is very vital that you give the proper business plan. And I have also seen many times when you give the business plan or business case scenarios, many companies or many applicants, they write, okay, we want to do the mobile based application, we want to do the loan through a mobile. Now it means if you are entering a fintech space, or if you are want to do the the mobile based or a digital based lending, you need to be more clear about who are going, what is going to be platform, who are going to use the platform, what are connection between you and the platform. All that thing you need to give before end to the applications, because otherwise you are going to get the questions. And many times, if you have the foreign shareholders, I think that also RBI is bit have a concern about your foreign shareholders, especially if the shareholders are from China. RBI definitely will go for more details about this registration part, about the the shareholding and the background of this the Chinese shareholder part. So that takes me to friend the change of shareholding and directors. Okay, if you have any question on registration, we will definitely take up. Okay, now let me also tell you about the shareholding and director. There are in a good old days there was possibility that you used to buy 100% shareholding, of any NBFC, because RBI as on today is not charging for either registration or any change of control. But of lately from last 2 years we have observed that if I go to RBI with change of 100% of change of shareholding, you will find either the return of application or even the application is not accepted on the counter. So you have to be very clear. RBI will come and tell you that all promoters should go out of the business, surrender the license, and the new promoter should apply for the new license. So change of shareholding, though there is no prohibition under the act, but RBI as on now is not accepting the 100% change of shareholding unless you have a very good case to say that okay, I am buying over the business. There is some strategic buyout, or there is a very strong reason that I need to get into this business. And that, so I don't say that it is 100% no, but maybe 80-90% no when you want to go for a change of shareholding. Okay, many times even the change of shareholding, here when we are talking about change of shareholding, let me also tell you some of the cases which we are seeing on day-to-day basis. People believe that only change of shareholding up to 20 below 26%, I don't have to go to RBI, and they go on changing 10%. Okay, and from the last submitted shareholding to RBI, it may happen that you have changed 4 times. Every time you have changed 10%. So effectively you have changed 40%, and then the consultant or the promoters or director comes to us saying that we have never exceeded 26% limit. Here what you have to see, friends, from the last approved by RBI, what was the change in shareholding? So supposingly you have made an application, 3% there are 33%, there are 3 shareholders or 4 shareholders, 25% each. Okay. Thereafter, if all 3 are giving or 2 are giving 10% shareholding, and some new person comes, then there is no change of shareholding. However, if the third person also is giving a 10% shareholding, maybe after second year or after 2 years, then it will be triggered, because what you have to see, the change of shareholding more than 26% is where the change of shareholding is in the holding company. Okay, there was no change of shareholding in my holding company because the NBFC is still held by the holding company. There is a change of shareholding in the holding company which is more than 26%, then it is not required to be, we don't have to go for a prior permission of RBI. Here also, I think one has to be very clear that if the change is in the NBFC shareholding or a holding company shareholding more than 26% from the last given to RBI, you will have to go for a prior permission, to RBI. Options to avoid this 26. It's better to take a prior permission and solve this matter. Other very important things is change of directors. Surprisingly, any change in the management of applicable NBFC, which result in more than 30% change of directors, okay, then also you have to go for prior approval. Here people say 1/3, so here one has to be very clear. I don't know why this 30% has been used and not why 33, because if there are 4 directors, okay, how the 30% should be reckoned, nobody knows. But we will have to see pure mathematics, and more than 30% change of executive directors means directors who are not independent directors, then you will have to take a prior permission of RBI, and then only you will be able to change. So if there is supposing there is one director change and there is a second director change, here there is no, the cascading effect. But in any case, whenever there is a change of director where their prior approval is not required, at least there is a norm that within 1 month you will have to inform to RBI. We normally suggest to client that please inform 1 month prior, because RBI asks lots of detail about the incumbent or incoming directors and about their group companies. So one has to be very clear, on this registration part and the change of shareholding and director part. And I'm sure, friends, you will have lots of questions on this. So, after the session, means after we complete, we'll definitely take all your questions on registration and NBFC. That takes us to the recent developments, because apart from registrations and change of shareholding and directors, we also need to cover what are the very important key recent amendments. And Kunal, if you can just take it forward.
Yeah, thank you, Bhavesh. So there, as Bhavesh rightly pointed out in the address earlier, that there have been various circulars that have come during the COVID period where RBI has made, I wouldn't say minor, I wouldn't say major, but substantial changes in the regulatory regime for NBFCs. The changes have, had forced a lot of big NBFCs in the sector also to rethink their position of having an NBFC in the group, and some initiation of mergers, demergers have already started commencing. So what is the key route from where, the shift in the regulations started was that comes from the scale-based regulation circular of RBI, which came out as a draft discussion paper some years ago, and in 2021 it came out with a bang. What it does, it basically, as I said earlier, the classification of an NBFC on the basis of deposit taking or accepting, or on the basis of size, or on the basis of nature, has now been pushed into whether it is a base layer, middle layer, upper layer, or top layer. Let me run you through these basic layers that are there. So all NBFCs that have asset size less than 1,000 crores are generally covered under the base layer, with some exceptions. Those exceptions I will cover later. Apart from those, peer-to-peer lending platforms, account aggregators, non-operating financial holding company, and type 1 NBFCs. Type 1 NBFC means you are NBFCs which do investment activities from their own funds. These NBFCs will always be in base layer, no matter what their asset size. Why this classification in the base layer is because these NBFCs don't generally have recourse to large amounts of public funds, and RBI has drawn in even in its discussion paper has highlighted that these types of NBFCs, although big in size, do not pose a systemic risk to the financial system, and therefore getting them regulated under the base layer would not be of any harm, which was also the recommendation of the committee formed for this purpose. Moving to the middle layer. Now, NBFCs that have asset size of more than 1,000 crores, NBFCs, infrastructure finance companies, SPVs, and core investment companies. Now, here, core investment companies, by CIC, I mean 100 crore plus, which are registered with RBI. No matter what their asset size, are still covered under middle layer or more. And CICs which are registered with RBI cannot be classified as base layer NBFCs, is what the circular says. The upper layer is basically the big leagues of the NBFC industry, which RBI wants to have an enhanced monitoring and supervision on. And to identify those NBFCs, RBI has prescribed an elaborate scoring methodology where roughly 40 to 50 NBFCs come within the top layer and upper layer. And then comes the top layer, which is more like the recommendations of the Basel Committee, where which this top layer is generally going to be empty, but only in the banking nomenclature there is something known as SIDBI. This is the same concept that they are bringing in the NBFC space as well, where the highest level of monitoring and supervision, as good as a bank, will be done at the upper and the top layers. So this is the broad change in the approach of the regulation that is going to come. The change in the way RBI is going to monitor the functioning of NBFCs that is going to come in, and this circular kicks in all its force. I mean, one part of it has already kicked in from 1st April 2022, but a majority chunk of it gets kicked in from 1st October 2022 onwards, and certain phases get over in March 2027. So there are, for some aspects of the regulation, there are transition paths given that go up to 2027. So what are the changes that are coming? I will try to cover the most important broad changes that are coming in, which are relevant for majority of NBFCs in terms of number, which is that the investment and credit companies net owned funds, mind you, this is for existing NBFCs that were registered before 1st October 22nd October 2021. Those NBFCs have the option to uh, reach the 10 crore net owned fund requirement by 31st March 2027. NBFCs that have applied to RBI for certificate of registration after 22nd October 2021, and for those applications, RBI has taken a position that such entities or such applicant companies have to make the minimum net own fund of 10 crores by October 2022 itself, and they do not have the option of getting the glide path till 31st March 2027. MFI again has been raised to 10 crores, NBFC factors has also been raised to 10 crores. So the variation in the net owned funds that existed with the bare minimum starting from 2 crores and going up to 300 crores is now the minimum benchmark has been raised to 10 crores. The other aspect is having experienced board. Now, since last 3 to 4 years, while we were you apply to RBI to acquire an NBFC, this was, although an informal, but a minimum requirement stating that, as Bhavesh Bhai rightly pointed out, whether the board has the experience to run the NBFC, or does it have the practical aspects necessary to, maintain the operations of the NBFC. And that is precisely what now they are codifying in the laws itself. Another important milestone achievement that, or a milestone change that is coming into the picture is the 90 DPD standard. Now, previously there was a regulatory arbitrage between NBFCs with asset size less than 500 crores, where NPAs were classified as NPAs only after 6 months, which are now going to transition to 90 DPD with effect from 31st March 2026 across all types of NBFCs. The other important change that was brought in and has kicked in with effect from 1st April 2022 is the IPO subscription limit, where RBI has now mandated NBFCs to restrict the funding for IPO subscription per borrower to 1 crore rupees, which or lesser. Of course, banks and of course NBFCs have the option to lend less, but not more. So this is one substantial change that has come in. Other important changes that have come in are more to do from the internal workings and prudential guidelines perspective. Like there is a change in the capital assessment and internal capital adequacy process, where now in terms of the pillar 2 of Basel III standards, even NBFCs that fall within the middle layer and upper layer are now required to conduct this assessment. NBFC upper layers with effect from, I think so, the circular dated 19th April has clarified that now they will follow the common equity tier 1 capital standards, which is applicable to banks. For upper layers, they're also bringing in leverage ratio, restricting the credit growth in terms of regulatory requirements, in addition to the existing CRAR requirements that exist. Apart from those, the prudential changes that exist that have been brought in is introduction to large exposure framework, which is also applicable to NBFC upper layers. Sensitive sector exposure tracking are additional disclosure requirements that have been given for all NBFCs, which we will discuss when we reach the disclosures page. Uh, this has mandated the disclosure of real estate exposures to the real estate sector, exposures to the capital markets, and a detailed breakup of that has to be given not only in the notes to financial statements, but also on the website of the NBFCs. The other important aspect is restrictions on loans to directors and senior management of the NBFC. Now, all forms of NBFC, some sort of regulations have kicked in which restrict the amount of loans or the way or manner in which financing companies can give loans to its senior management and KMPs. Other important changes are dedicated directors and KMP, which means that one KMP of an NBFC cannot be a director in any other company except from its wholly owned subsidiary. Another important point is appointment of chief compliance officer. These requirements, additional disclosure requirements, core financial services solution. I will take a minute here. So just how banks have prescription of core banking solution, NBFCs, the ones prescribed, are now required to have core financial services solution wherein all their branch operations are linked within the same ecosystem. So it is very similar to the core banking solution. The only difference is that deposit accepting and not all products of banks may be replicated in this software. But this software requirement has also been prescribed by RBI. And another important guideline that has come in is in terms of the remuneration to senior management and directors and how that is to be conducted and what is going to be the basis of it. Of course, RBI does not get into the commercial aspects of it, but it does prescribe what are the broad parameters that needs to be considered when an NBFC is going to remunerate its directors and key managerial persons. Apart from that, as we said, that the NBFC upper layer has increased monitoring scrutiny, and because of that, a lot of additional compliances kick in, additional monitoring, additional supervision aspects, return filings kick in. So that is a very brief on the scale-based regulatory ecosystem that functions into this. And I would request Bhavesh Bhai to give us his views on how this paradigm shift is happening in the scale-based regulatory system and what we are moving towards.
So thank you, Kunal. Friends, let me see. I don't know if any of you have gone through this circular of October 2021 on a scale-based regulation. I see this circular has is again the new paradigm shift to the whole NBFC regulations. Like in my initial talk, I told that somewhere in 2007 the regulation came, which was very important. 2016 the regulation got revised, that was also important. And now, you'll realize maybe 6 months down the line that this circular, which is very, very silent but very important, and not talking much, we're giving very philosophical point, which is October 22nd, 2021, which talks about scale-based regulations. Now, what it shows, till now, RBI has only two ways of looking at it: the NBFCs which are below 500 crores and NBFCs which are above 500 crores. Okay, and they have been looking at separately. Though at their level, they are looking at more than 1,000 crores, more than 5,000 crores, more than 10,000 crores. But RBI has realized that if 20% NBFCs are doing 80% of volume, then why don't to regulate those 80% rather than spending time on all these companies? So RBI, through these scale-based regulations, has divided the company below 1,000 crores, 1,000 to 5,000 crores, 5,000 above, and 15,000 above. But that is not the end of it. Once we discuss more about auditor directions and about other regulations part, you realize that the entire regulations is now getting akin to the regulations which are those for the banks. Okay, so these are the small doors, I say, which has been started, and it looks that RBI intention is now to match or synchronize the entire regulations with those with the banking regulations. Personally, with this many experience I see, there is a very big shift in the mindset of a regulator, where the NBFC regulations are now moving to a banking regulations. So any of you who are practicing or want to practice in a NBFC regulations or NBFC, you will have to understand it is not different than the banking regulations at all. If you see many things like appointing the compliance officer, chief risk officer, or capital guidelines, auditors, all that things which has been, this base layer NBFC, middle layer NBFCs, top layer NBFCs, upper layer NBFCs. This all says that now you may find that NBFCs SI and non-SI will not be very relevant in time to come. We'll have a separate guidelines for ML, BL, TL, and UL. And whatever we are reading today, so maybe after 1 year, if Borivali Study Circle again calls, we will say, no, this SI and non-SI has now no relevance. Now you have to go for a new regulations. So this is a big paradigm shift in the regulations, which is now very small. And from October, it will be very much operative. Certain part has become operative from April, but majority part will become operative from October. This SBR, which is scale-based regulations, is now going to be very different. The other thing also we have to see that RBI today, and which Kunal took you to the activity-based bifurcation of the NBFC. So we may find that from activity-based NBFC bifurcation, RBI will go from a volume-based. So supposingly I have gold finance company, I have a microfinance company, I have investment, I have loan company, everything may be clubbed under one based on the asset size, and based on the activity they will go on monitoring through a ML or BL. So we will see this change in the regulations, which is likely to come in on this scale based regulatory system. Here one thing also I would like to tell you, which is a small silver line, that there are NBFCs, supposedly you have your own network, you have not borrowed anything, and you are investing in the securities market only, okay, which is precisely a type 1 NBFC. And everybody is arguing that what for type 1 NBFCs, why we have to undergo so many compliances. And we have so many companies, and I am sure your client also has, that the promoter has 2,000 or 4,000 crores or 6,000 crores as a type 1 NBFC. They have a net worth of about 3,000-4,000 crores, and they are holding maybe the securities worth rupees 4,000 crores, maybe in any listed securities. Why they should be go in the middle level or a base layer and then follow 3-4 auditors and all that stuffs. So one line RBI has written in the circular that they are aware of the fact that the NBFCs who are or NBFCs which are only investing NBFCs out of their own fund, they are likely to come out with a separate guidelines or maybe separate regulations. So we should not be surprised that which was the demand for so many years, that if there are NBFCs who's who have the network of their own and they don't have any customer interface, or they are only making the investment in listed or unlisted securities, they will be barred. They will be out of this scale-based regulations or some new regulations which may come in for this. So this is from my side, Kunal, and now you can take to the next slide. Yeah.
So while we were in the scale-based regulations, we also thought about running everybody, the participants, through important accounting aspects which entail an NBFC. There are certain additional amendments here, but for the brevity of making it convenient for the participants, I've noted down all important points with respect to accounting that exist for an NBFC. One specific point is the cash flow statements, which often happens to be the case that small companies that are NBFCs, say of 2 crores, 3 crore asset size, don't really comply with the cash flow requirements and therefore don't prepare cash flow statements. Now, under AS3 as well as under India AS7, both of them, these entities, both of these accounting standards prescribe that if you are an NBFC, you're required to prepare cash flow statements no matter what. Given the other important aspect in accounting is the reserve fund under section 45 IC. Now, RBI under 45 IC has prescribed that 20% of your net profit is to be appropriated into a statutory reserve as reserve fund every year. What unfortunately RBI has not prescribed is the possible utilization of this reserve fund and where these can be used and how these can be used. The only approach for utilizing these is to write to RBI stating that this is what our plan is. Either we want to convert these capital reserves into bonus shares, or we want to do this or do that. Only with specific approval from RBI can those statutory reserves be utilized. And I would like to extend myself into saying even after you surrender the NBFC license, because I do not know whether the accounting standards permit conversion of capital reserve to a general reserve or a free reserve merely because of change in the licensing requirements, and this is a debatable topic. The other important point is the income recognition. I think so this is important not only for an NBFC but all sorts of financing entities, which the generic standard or the gold standard is the DPD solution, days past due. Income recognition for NPAs is an important aspect that we need to ensure while we're auditing the financial statements of an NBFC, especially the reversal of unrealized interest income. So once an NPA is triggered, the interest income that is unrealized and still booked has to be reversed within the books of accounts. Another common thing that happens in small NBFCs is that the reversal only takes place at loan account level, which RBI has specifically provided that it has to happen at the customer ID level, where if there are 3 or 4 product exposures to the same borrowing party or the same group of borrowers, then if one product is turns an NPA, everything turns NPA. And clarification to this effect was also issued for cash credits and overdraft by RBI recently. Another important point is the provisioning aspects of standard, substandard, doubtful assets. Standard assets are provisioned at 0.25% if you're less than 500, 0.4% if you're more than 500. Of course, that is going to change once scale-based regulation kicks in. For NBFC upper layers, there's going to be differential standard asset provisioning. For substandard, it is 10%. For doubtful, the buckets apply. For secured. For unsecured, it has to be valued at 100%. The bucketing ranges from 10, 20, 30, and 50%. Doubtful 1, doubtful 2, doubtful 3 is what we call it. Moving to disclosure aspects of things now, Para 19 disclosures is something which RBI, so Para 19 means Para 19 of the non-SI master directions. RBI has prescribed a detailed disclosure requirement as an annex to the master direction, which has to be enclosed in the financial statements. What happens, or what I have observed, is some balance sheets don't have the previous year amounts, which is a mandate by both not only the Companies Act but also the accounting standards, which unfortunately RBI's format does not have. So this is a word of caution here, friends, that we make sure the client not only gives the current year figures but also the previous year figures. Liquidity risk management is another behemoth that we are going to discuss later. There are certain disclosures that have been prescribed by those regulations that are applicable to 100 crore plus NBFCs, which are required not only to be discussed in the disclosed in the financial statements but also on the website of the company. As I previously said, the loans to directors, senior officers, and relatives has now gotten more restrictions from the regulatory front, which need to be looked after. Other disclosures range specific transaction specific disclosures, such as currency, participating in currency futures, or for that matter, interest rate futures. And of course, Ind AS. Now, for Ind AS, the accounting aspects will range from so there was a very big time span wherein there was a regulatory ambiguity where RBI had not come out with specific clarification or guidance in terms of what happens when India kicks in for phase 1 and phase 2 NBFCs. Now, that position or disclosures that position has been settled thoroughly, where RBI has mandated that there will be a prudential floor. What that means is that RBI's prescribed requirements of provisioning has to be made no matter what. You can make a higher provisioning but not lower. Of course, the nature of entries, that whether that will go through ECL or whether that will go through some other specified reserve account, that we can examine, and those differences exist. But fundamental point of that regulation or that circular of RBI is that RBI wants NBFCs to comply with the minimum standard of 90 DPD and 180 plus 90 DPD and make the provisioning in terms of the bucketing that has been prescribed by RBI. Apart from this, on 19th April 2022, RBI has prescribed a very large circular with detailing lots of disclosures ranging from capital market exposures, real estate exposures for all NBFCs. Then for certain middle layer and upper layer NBFCs, they've also prescribed corporate governance related exposures, how many times the fit and proper criteria has been examined is what has also been looked at into that regulation. So from an accounting perspective, RBI has covered quite a lot of ground, all right from your capital structure and your liabilities all the way to your assets, as well as the provisions and off balance sheet items as well. Moving to a more dividend rich chapter or a dividend rich topic is about dividends, where in 2021 RBI has prescribed certain payout ratios or restrictions as such on which NBFCs can issue dividend and which NBFCs cannot. Thankfully, type 1 NBFCs have been kept out of the dividend payout ratio provided it meets the eligibility criteria. So when I say dividend payout ratio, what does it mean? It means the amount of total dividend payable during the year divided by the net profit for the financial year for which it is being proposed. I don't know what will happen to the accumulated profits of previous years and whether that will be available for distribution as dividend, or whether we are linking it directly to the current year's profits only. That is an examination that needs to be done. Say for example, in FY21 I earn 100 rupees and I don't declare a dividend, and in FY22 I earn another 100 rupees, and if I want to declare a dividend of 60 rupees, whether I am allowed to do that if I am an NBFC. That examination still needs to be done. The regulatory clarity is still not there. However, I'll just run you all through the prescribed dividend payout ratios. For core investment companies, it's 60%. Standalone primary dealers, it's 60%. All other NBFCs, it is 50%. And those which don't meet the eligibility criteria can only distribute 10% if they fulfill two conditions. One, that their net NPA ratio is less than 4% for the same financial year, and that it fulfills the capital adequacy requirements. Now, when I say eligibility conditions, what does that mean? So RBI has stated a three-pronged approach, I think so, of which one is a generic approach, but two are very specific. One is that capital adequacy for all of last 3 years has been complied with. And the second is net NPA ratio is less than 6% for all the previous 3 years. all these three conditions, and of course the third is compliance with 45 IC and other generic regulations, only then you are eligible. Now, I don't know to what extent we will be able to say that a small exception reporting by the statutory auditor on stating that disagreement in terms of provisioning requirements, whether that makes the declaration of dividend ineligible if the auditor highlights that in the auditor report, is still a debatable topic. There are reporting requirements that have been prescribed to NBFCs and various types that has to be done within 15 days to the Department of Supervision of the regional office where the NBFC is registered. With the dividend, I think so we move to 2 or 3 new important things that have come into picture in lately. One is the issuance of credit cards. Now RBI on a standalone basis has allowed NBFCs to issue credit cards. Previously, RBI had allowed NBFCs to issue only co-branded credit cards in association with some other issuer. But now, with prior approval of RBI and board approved policy and minimum net own fund of 100 crores, NBFCs are allowed to issue credit cards as their own asset portfolio. Co-lending model between banks and NBFCs is another important topic that had come, although this came in 2020. But this is a very important aspect or a business model that exists, especially in the MFI space as well as in the fintech space, where banks and NBFCs NBFCs lead as the originator, whereas the risk exposure is taken both by banks and NBFCs. Now, between this arrangement, there is a master agreement that exists between the bank and the NBFC. If there is a minimum commitment by the bank that, okay, this is going to be the minimum origination component of the exposure is going to be onboarded into my asset size and my asset size, then I will take over that component of the loan, and that can happen through the direct assignment of receivables, which exists in the RBI notifications. Here, RBI has specifically exempted from the provisions of maintaining the minimum holding period. RBI has also stated that NBFC will act not only as an originator but also as a single point interface for the customer to interact with respect to all aspects of the lending or the loan, as the entire loan. A smaller aspect or a more unimportant aspect of it is that the transfer between banks and NBFC, the client's funds that get transferred via NBFC to banks and vice versa, happens through an escrow account. A very important point that RBI has stated here is with respect to the business continuity plan forming part of the overall business continuity plan. That what happens when your co-lending partner cannot service things, or so that is something that one needs to examine. This is primarily used in the priority sector lending PSL areas. However, co-lending arrangements between banks and NBFCs exist, and they follow more or less the same contours of the regulation.
Here only one thing we have to understand, that this is why this co-lending model has come. Because the NBFCs have ability to go to the unserved and underserved area. And RBI wants this, especially after COVID, because this circular, I think, has come August 2020, maybe in a COVID time it has come. And mainly, as Kunal rightly said, in a priority sector. People area where NBFC NBFC is a rich BSC. Yeah, so NBFC can reach, but they are unable to give the fund. So now RBI has come out. The bank and NBFC can forge an alliance. They can come in alliance where bank through NBFC do the co-lending to the unserved and underserved people. I think this has not picked up very well, but my reading of this that many banks will go for a large NBFC or NBFC who has lots of fintech contacts. So we will see. To my understanding, this co-lending model CLM is going to be is a very I also welcome initiative by RBI. Yeah, Kunal.
Yeah. So co-lending model, as we say, is also paving the way towards FLDG sorts of business model that currently exist in the startup culture. Uh, as I stated earlier, that RBI has also in the last notification prescribed restrictions to loans and advances between NBFC middle layer and NBFC upper layer as well as base layer. Now, what are the requirements under this? I'll just brief you them. That NBFC upper layer and middle layers cannot issue loans to directors or their relatives or the entities that they are associated with in excess of 5 crores without the prior approval of the board or a committee comprising of directors. This is a very big change, friends, which has come in, which acts as a stopgap in addressing the conflicts of interest that may arise in middle-sized NBFCs. Another that are transitioning to a more formalized governance structure. Another important point that has been prescribed in the circular is more to do from the loans to senior officers. All those also have to be reported to the board, and these limits apply also for awarding contracts. Apart from these, the said regulation, although it does not say it explicitly in the heading of it, but it inserts one more point into it, which talks about disbursement to the real estate sector. And what it clarifies is that if you are lending to the real estate sector, which RBI considered as a sensitive sector, although the sanction can be done initially before the receipt of clearances, but RBI has mandated now that NBFCs in middle layer and upper layer not to disburse any funding to the real estate sector unless and until all requisite clearances by government and statutory authorities are in place. For NBFCs base layer, which are those which are less than 1,000 crores and type 1 NBFCs and such, as we discussed earlier, RBI has mandated that we have a board approved policy. Now, this board approved policy is required to broadly lay down the contours on that, on what basis is the NBFC going to lend to its directors and senior officers, what are the parameters that are going to be examined, and how the conflict of interest is broadly going to be addressed. With this, I think so we move to another important aspect of the recent change that has happened is with respect to the compliance function. Now, RBI has been, really active in terms of adding compliances in the last 4 or 5 years to NBFCs commensurate with the growth and complexity of operations that the industry is facing. What we have seen is that RBI has moved with an ideology not to monitor. So RBI's progression as a regulator, for especially for the NBFC space, has moved from somebody who monitors the operations of a regulated entity off-site to monitoring them on-site to prescribing them day-to-day operational requirements. And now I think so the shift is coming where RBI wants a strengthened governance mechanism across the industry. If you see in the last 1 year, the notifications or the circulars that have come are substantial changes, are principle oriented, but they all talk majorly about the board, the governance structure, the mechanism, the audit committee, the compliance function, and this specific circular is specifically focused towards that. where RBI now says that just like an independent audit committee, an independent compliance function which runs parallel to the day-to-day management of the company needs to be established, where risk responsibility, of course, stays with the board and the senior management, but the operations of the compliance function will be as independent as that from as an auditor or an internal auditor. To justify that, RBI has already stated that there will no dual hatting will be allowed for uh, members of the compliance function to operate in the normal day-to-day affairs or the profit-oriented affairs of the company. Chief Compliance Officer's appointment has also been mandated for NBFCs that have asset size of 5,000 crores and more, wherein is how his appointment is required, what are going to be his terms, responsibilities, areas of interest, and what the minimum tenure is going to be. In this case, it is going to be minimum. He has to be appointed. He or she has to be appointed for a minimum of 3 years. So RBI has moved more from a financial numbers based regulator to a more corporate governance, strengthening the board form of a regulator, which is a breakout moment in the regulator for the industry, because this is what we had observed when Sarbanes-Oxley had come in the US, and a similar transition of sorts that happened then at the SEC is what we are witnessing here at RBI for the NBFC industry. Moving to the one of the few things that have been a part of the update has been the Ombudsman scheme. Now in 2021, RBI has come out with the integrated Ombudsman scheme. What it has done is now banks, NBFCs, payment processing participants, and RBI regulate prepaid payment instrument issuers, all of them are now covered under the umbrella of the integrated Ombudsman scheme. For those that are not in line with what it is, the integrated ombudsman scheme is an alternate resolution mechanism of RBI for addressing all complaints against banks, NBFCs, etc., where a customer can go and complain against it. What we have seen is that a lot of small NBFCs are unaware of the functioning of how this has moved. Now, the simple example that I would like to highlight here is that a lot of NBFCs don't yet know that RBI's complaint mechanism has now shifted digital to the RBI CMS portal, complaint management system portal, where NBFCs get a lot of complaints that they have as a dashboard, and you are required to respond digitally to that, which a lot of NBFCs don't get in touch with, and that those complaints keep pending, and then show cause notices come, as stating that there were multiple customer complaints against you all, but that has not been done addressed. This may also lead to misrepresentation in the financial statements, because NBFCs are now required to disclose how many complaints have been filed against them in the financial statements. So these aspects also cover the Ombudsman scheme. The details of it are very similar to the NBFC Ombudsman scheme that existed much before. And it also prescribes certain disclosure requirements and appointment of principal nodal officer and nodal officer who represent the NBFC in front of the Ombudsman of RBI. And with that, I think so we cover a very substantial part of the recent amendments that have come in the last 1 or 2 years. Of course, given the brevity of time, we haven't covered a lot or all of them on a majority basis. But of course, we will be happy to take questions after the session. I think Sharad bhai, if it is okay, we can take a 5-minute bio break. If that is, if we have accounted for that, or shall we proceed?
Yeah, we can take. 5 minute bio break, no problem.
Yeah, only 2 minutes, Bharat bhai.
Yeah, before.
All right. So we'll reconnect in 5 minutes.
Yeah, Bhavesh, you want to say something?
No, only 2 minutes. No, only 2 minutes. I'm seeing so many questions.
Okay.
So if
okay.
anybody has a questions, they can put on the chat. So we can.
No,
answer it.
but everybody is requested to put question on Q&A rather than chat.
Understood. That's better.
Please. Yeah, we'll take
Okay,
break for 2 minutes, please.
Yeah, understood.
Yeah, Kunal bhai, can we start?
Yeah, we're just waiting for.
Yeah.
Yeah. So
Yeah, Mr. Kunal, you can start the session again.
hello. Yeah. So am I audible?
Yeah, very well.
Yeah. Okay. So the next important agenda that we thought we will touch base on is with respect to core investment companies. And I would like Bhavesh Bhai to, run us through the entire aspect of what a core investment company is all about and what practical things that we face on a day-to-day basis. Bhavesh Bhai.
So, friend, I think no lecture is completed without we discuss the core investment company. No lecture of NBFC is completed without this concept of core investment company. Now, this is something, let me tell you, in good old days, there was something like an investment company. Okay. The investment company means their role was only to make the investment, because the RBI definition has said that any company who are in the business of either providing loans or making the investment. And when I say investment, okay, they have said use dealing. So don't go by that income tax definition that okay, if I do stock in trade, whether I'll be out of NBFC. I am not discussing that part today. So what RBI said, that if you are dealing in investments or if you are giving in loan, you will be a NBFC with 50%. Now, because of the investment companies were being companies, they were also been covered. Now, in that case, maybe in somewhere I came with the new sort of regulations on a core investment company, and this is very important, because I'm sure that many of us who are doing audit, where the group company shares are held, they will have to verify whether it's a core investment company or not. And I think there is lots of confusion, which to my understanding it is a very simple definition of core investment company. So let us take what is a core investment company. Core investment company means that any company, first of all, please understand is a company. So I'm holding my group company shares maybe in a partnership firm or maybe LLP. I'm not discussing. Core investment company is any company which is holding more than 60% of their asset, not a net worth, my dear friends. More than 60% of their asset in a group companies, okay, as a equity share capital, okay, and balance 30% either debt and equity, and from balance 10% if they can do any non-financial activity, that one will have to see. And when we are thinking about this asset, one will have to consider the net asset. So if your cash on hand something like that, you will have to minus. So if I have 1,000 crore book and I have cash on hand maybe for a bank which 100 crores to 200 crores, I will have to see the condition post minusing, intangibles and all that cash and bank balances. So the rule says that when I see the balance sheet, this is an asset-based test and not a liability-based test. So in my asset, if I have invested more than 60% in equity shares of my group company, it triggers the CIC. And but from balance 30%, if I have invested in the debt or equity of CIC, it is okay. But from balance 30%, I have seen many companies, 100 rupees is the asset size, of course, net asset size, 60 or 75% in equity, and out of 25%, they have given loan to somebody, or they have maybe invested in some other securities. Then it will still be NBFC and not a CIC. So, my friend, let us be very clear that CIC means 60% is equity, but out balance 30% means balance 40% or 30% has to be in a group company. So exposure to group company either in a debt or equity, without which you will not be considered as a CIC. Then the question came to RBI, that if I am investing with my own funds in my group companies, then why I should be, required to be regulated? RBI took it, in a very positive manner, and RBI said, okay, look, if there is a asset which are below 100 crores, whether you are accepting public fund, you are not accepting public funds, or you are not accepting public fund, even if the asset is greater than 100 crores, okay, your group company asset, then don't come to us for a registration. Okay. Now this is, I think, very important point which one will have to understand, that if you are first, so let us understand how this test has to apply. If you are a company holding more than 60% in your group company, balance 30 or 40% is also the exposure to group company, you are a CIC. So question number one gets satisfied. Secondly, if you are below 100 crores in the size, whether you are borrowed, you are not borrowed, has to be forgotten. Don't go to RBI, you don't require registrations. Okay, this specifically used many times when you do a merger acquisitions, or do many group structuring, or a reorganization of the group through SPV. Suddenly you find that one of the companies become SPVs become the CIC. So that way this is very important, core investment company. And if you are above 100 crores, but you are not borrowing, then also you are not required to be registered. Only one thing we have to understand here: when you are not required, or when you are exempt under 45IA, earlier, the exempt CICs were been claiming that, okay, we are exempt as a CIC, and they were claiming that we are exempt CIC. So they were saying that, okay, we have some, upper class of CIC. RBI has understood that many CIC is using this exempt CIC concept it is giving a wrong notion. So RBI last year, somewhere in August 2020, RBI has said that if you are not required to be registered because of this definition, you cannot claim that you are exempt CIC. You will have to say you are unregistered CIC instead of exempt CIC. So the exempt CIC concept has now gone. It is unregistered CIC or registered CIC. So one has to be very clear on that aspect. Second is, recently, we discussed about the scale-based approach of RBI, where we discuss about below 4,000, below 1,000. CIC by definition has been put not under base layer, but under middle level. So RBI surprisingly feels that CIC has much more systemic risk than, the NBFC. So just to give you the example, if I have an NBFC which has 700 crores in a size, it will come under base layer, under scale-based approach. But if I have 700 crores CIC which is registered, it will come under middle layer. So this is something, which I have not also understood, because normally CICs are holding the asset in their group company, because mid-level, companies are required to have a higher version of compliances than a base level. So even if you are a CIC with 300 crores or 200 crores, okay, and you have NBFC in 800 crores, or both will be treated. So if you have NBFC with 800 crores and CIC with 200 crores, CIC with 200 crores will have a higher compliances than NBFC with 800 crores in going forward. Now this is something is difficult to reconcile, but that is a fact now with the new regulation which has come. Also, let me tell you, about this limit in layer of CIC to 2. Earlier, before the Company Act also changes, people were having CIC below CIC and CIC below CIC. There were layer of CIC. If you remember, Company Act also has been amended, stating that you cannot have more than 2 layers of companies. So if I have A holding company, B subsidiary of A, and C will be subsidiary of B. So A, B, C. Similarly, now also in CIC, you cannot have more than 2 CIC below the layer. So in good old days, you could have a structure where there are 10 CICs below the parent CICs, So that has now been gone, and rightly so. Here one will have to understand that even I have a CIC below my CIC, but when I am calculating the adjusted net worth, or a net worth, whatever I'm holding, which is more than 10% in my investee CIC, will be minus. And why I'm telling you, and I don't want to name some of the companies here, but what used to happen, the CIC can also borrow. So I will borrow in CIC. I will invest as an equity in my subsidiary CIC. My subsidiary CIC also will borrow, and they will invest again, in their subsidiary CIC. And this was a problem which RBI, could find in one or two of the problem. So RBI said, okay, look, we don't understand this group CIC. So whenever you are calculating the net worth of your CIC, investing company, then in that case, you see you minus the 10%, more than 10% of your net worth invested in the CIC. So that is a very welcome feature. So you will not able to, the borrowing will not be used to count it as your net worth. The next important is a group risk management committee. If there are CICs within the group, means CIC, below CIC, all that, then the group risk management committee has to be approached. Normally, the group risk management committee has to be built in by the parent CIC or the CIC which is bigger in the group. So sometimes you have the smaller CIC, but your subsidiary has become bigger than the holding company. So as I normally, even if you see Maruti Suzuki, today India Maruti Suzuki is bigger than the parent. So many times it happens that subsidiary company has become bigger in the size than the holding company. In that case, group risk management committee should be formed by that larger company if the parent is not identified. The other important part is that if the size of CIC is more than 5,000 crores, and again the asset size, okay, then the chief risk officer has to be appointed. And many times this CICs, all these companies are the companies where promoters are holding their, shares or holding their investment in their group company through a CIC. And if they are going to follow the index, we have seen many companies are going above 5,000 crores in no time. But in that case, in index balance sheet, for many group companies, if the asset is more than 5,000 crores, they are supposed to have the chief risk officer and the risk policy, all that will come up. Next important part is the consolidation of financial statement in a CIC. Now, if by the statute or by the MCA or by the ROC or by the Companies Act or by the accounting standard, if you are required to be consolidated, then there is no issues. The problem comes that you have a CIC below CIC, but you are not required to consolidate, because of statutorily it is not required. So here it is very important, which I have seen most maximum auditors have really not performed their duties to the best. Here, when there is no consolidation required under the statute, then you have to give the information in, as a separate disclosure for all the CIC, all your investee or portfolio companies in a desired format, which is annexed to the circular. So if anybody is doing the audit of a CIC, where CIC is not required to be consolidated, the CIC which is a subsidiary companies or in the layer down, then under the notes to account, the separate big disclosure has to be required for all the group companies which otherwise coming as a otherwise not coming as a consolidation. I think this we have seen many times. It has been missed by the auditors in giving the note in the notes to account. There are some additional disclosure also which is required to be nowadays to be given, for a CIC, giving under the Companies Act or accounting standards, accounting policy. Their separate disclosure also is required to be given for a core investment companies, which is annual report and the adjusted net worth we have to give, and total amount of direct or indirect capital contributed made by another CIC. So lots of other disclosures, which is a part of the disclosure requirement of the CIC, that also one has to see. If anybody, and let me tell you, here one more thing, that there are about 68 CIC only registered, okay, and the total company registered in India is about 14 lakhs, right? But one has to be very clear that even there are 68, okay, and I don't know, on 68 to 14 lakh companies, you will have to Even the CARO also talks about the CIC reporting. If you see the recent CARO 2020, which was applicable from from March 23 for all the audits which we are doing nowadays, that also talks about the CIC. So one has to be very clear before you are giving the audit report. From a CARO point of view, also you have to examine whether it's a core investment company or it is not a core investment company. This very important part of a CIC. One will have to understand that if they are not borrowing, then they will be exempt, for getting it registered. And last thing also one has to understand, if there is a core investment company, like a prudential norms of a systemic important or a non-systemic important, there are also the norms for a core investment company. So if any of you are doing the audit of a core investment company, they will have to go through Reserve Bank master directions, okay, for a core investment company separately before you really complete this audit. So these are friends basically for a core investment company. So if you have any questions, again we take. Can we go to next slide, Kunal? Can you go to the next slide? Friend, we have now some important compliance aspects because the whatever recent we already covered, but some of the important compliance aspects which we feel, which is really been forgotten or not complied with, that we can discuss. Thereafter, we can discuss something on a fintech, how the fintech platforms and how this fintech industry is taking the new leap in time and going to take a new leap in time to come. And thereafter, we'll take a auditor's direction. So Kunal, if you can take this FDI and ODI by NBFC, and then we can go.
Sure, sure. So, given the brevity of time, I'll quickly run through all the slides. With respect to the NBFCs, yeah. So, with respect to the NBFCs, the FDI is permitted under the automatic route with prior approval is required for the CIC structures. NBFCs are also permitted to raise ECBs in the track 3 mode. For the ODI structure, NBFCs can invest abroad, but only in the financial services sector. With respect to the core investment companies, they can invest in both financial and non-financial services sector. But CICs that have asset size less than 100 crores and want to invest in financial services sector abroad are required to first register themselves as a CIC. Now, this is a very important point that exists. There are certain requirements as to what extent can the investment be done and what is the credit exposure limits that can be followed, which entities, whether that investment is getting done in FATF compliant jurisdictions or not. That also has to be seen. Another important compliance area that I think needs examination is the liquidity risk management. It is applicable to 100 crore plus companies and has various reporting requirements. As an NBFC, you are required to create a liquidity risk management policy, and in the day-to-day operations of liquidity risk management, you are required to follow the stock approach. Now, during RBI inspections, a lot of times what we've gotten a feedback to the various companies is that the liquidity risk management is on paper, monitoring schedules are prepared, but no active steps are taken to comply with stock ratios. Say, for example, that my long-term debt to short-term asset or long-term debt to total liabilities ratio has to be maximum so much, or my collateral-free assets have to be maintained at all times at this ratio. Now, those ratios are unfortunately, firstly, not adopted by NBFCs, and secondly, not implemented, is what we have observed in our limited experience. There are aspects pertaining to structural liquidity, interest rate sensitivity, which are all, I think so, self-explanatory. Off-balance sheet exposures are something that are also not really considered well in the liquidity risk management profiles of medium-scaled NBFCs, which we need to as auditors, get into the nitty-gritties of it and look at the control environment around that. Private placement of NCDs is which are in excess of 1 year, is also an important regulation of RBI apart from the Companies Act requirements that exist. So if you are an NBFC and want to privately place non-convertible debentures, then you need a resource planning policy. Minimum investment per investor can be only 20,000, can be minimum 20,000 rupees. The verticals are two. One is where maximum investment per subscriber can be 1 crore, and one is minimum can be 1 crore. The whole idea of these limits is to, which are self-explanatory, is to avoid the chance of company indirectly raising public deposits. So this is the idea behind this. Now I think so. Leaving the NBFC space in its core nature and moving towards the digital aspects of things, I think I'll let Bhavesh Bhai introduce a few on the fintech areas of things.
Thank you, Kunal. I think from the past now we are going to present and then to the future, friends. Now, fintech is a word all of us have been listening day to day. So, two words which last 2 years has made the buzzword in the entire ecosystem. One is the startups, and one is the fintech. What exactly and what RBI? Let me first tell you very clearly whether fintechs is not a word which has been still defined by regulators. Maybe the RBI, maybe the SEBI. Okay, it has not still been regulated, these fintech platforms. Now, what these fintech platforms are here, and as I told you in my initial remark, that earlier you used to take 3 months to take a loan, and today 3 minutes on your mobile. Okay, by the time I will complete this slide, the money will be in your bank account, and not only bank account, you can purchase through Amazon, and you could have purchased the product also. So the entire operation cycle is shrinking from 3 months to almost 3 minutes. Now fintech is a word which is going with finance and technology. When they merge, okay, the word fintech comes. And fintech, of course, is very old word in the developed countries. Now, of course, anywhere, supposedly regulations and technology match, then it is known as RegTech. So we are talking as our chartered accountant profession that, or a lawyer, that like very soon you find the regulations and the lawyer and the practice of law and practice of accounting also will will handled by the machine. And many of the return filing portals, many of the consulting portals, so these are nothing but RegTech, friends. So when regulations and technology merge, it will become RegTech. Similarly, you may be seeing so many advertisements through IPL, when IPL was going on. Now whenever you see TV of the education tech, and there are many companies who have got a fantastic private equities. When the education and technology match, and especially in COVID time, when everything was through work from home and the study from home, okay, everything was online. At that time, if you see, the EdTech also has got lots of money. So education through technology. So it may happen that after 4-5 years, the technology will become your school, and not your school which you are been studying. So you don't have to physically go to your school and meet your teacher. You'll have a technology in front of you, and they will give you the SSC pass or a 10th pass certificate. Or we'll have to see, the time will come where the platform will give you the curriculum certificate rather than the schools. So this known as EdTech, means education and technology, which is merging, and the platform itself become the school. Okay, like similarly agri and tech, which is another thing which is coming nowadays, that farmer goes to mandi for selling their groceries and buying the equipments. Many companies have started agri tech. So farmer sitting in the farm through his mobile can sell his product and buy the fertilizer and buy any of the tools he may be required for toiling the land or for the farming. This is nothing but use of technology for your core activity is nothing. And when you are using technology for a financial activity, it is a fintech. So let us be very clear how this is going to move. And I have seen many, the engineer guys friends, IITians or many BE or MS or MTechs, they are now forging alliance with the MBS and or a chartered accountant firms or a law firms and starting a fintech startups because they can create. And other day even in our ICI lecture we have been discussing that today we don't have threat from other chartered accountant, but we have threat through a technology friend. So when we discuss sometime, Sarath bhai, when we call us for a reg tech discussion, we will discuss this in detail. That today as a chartered accountant, I don't have a threat from my other co-brother, okay, as a practice. But I am definitely having a threat, through a technology because it can make me out in a no time. And just to give you example, which we were discussing in one of the doctor, earlier if I have to really measure my blood pressure, okay, I had to go to doctor, wait in the queue. He will open that box, put some band around my arm, start pumping, and he will measure the blood pressure, and he will charge 50 rupees, 40 rupees, or whatever. Today, I think it has not happened. For measuring blood pressure, you have the machine available in medical store, and you can measure blood pressure sitting at home. Why blood pressure? Even the sugar machines are also been coming, and lots of other machines will come. So what has happened, friends? What was the doctor's prerogative has been taken over by technology. Okay, even the sugar, measurement, or mainly for a diabetic patient, everything is now available at home. And I don't know so many things I'm not discussing. So the profession has been very smartly, slowly, and very subtly going to a technology. Maybe doctor tomorrow, maybe a accounting profession also can go to a technology. So this is a big threat with a fintech. And as a word of caution to all my fellow brothers, about 235, I'm seeing the numbers. Get ready how you can overtake this fintech. Otherwise, we were discussing in one of the forum at institute. The days are not far when if I'm fighting some matter on depreciation, I will type word depreciation with relevant sum of the fact of the case, and I'll get the entire representation ready through machine. So I think days are not far. And what is the use of your knowledge and your portals and whatever you read? Tomorrow anybody can practice on a representation part, auditing part. We'll discuss about auditing tools if time permitting, how the technology is changing how we practice and our profession entirely. Keeping that subject apart, friend, fintech, in a NBFC is a new animal, and which has faced lots of good private equity. So lots of people have understood that sitting in India, if you want a loan, there is, you don't have to really go to the market and really scout for the loans. You should get it, sitting on the sofa on Sunday morning, you should get the loan. And that's why this whole mobile app which has come. And I'll just tell you how the RBI is going to look at it. So, in all good days, the entire loan or lending process was very high cost, time consuming. The risk profiling also was limited because if I meet some person, they will do my scanning that okay, I'm good to take loan, I'm not good to take loan based on my CIBIL score or based on my credit score or based on my bank statement or income tax paper. That were the only, the way in which the loan was given. And now it has been changed. Now if you want a loan, okay, I may not require credit score. I will just get the access to your WhatsApp data, and I will run through artificial intelligence that are you willing to pay back or not. What used to happen in good old days, the capability to pay only was verified through a credit score, but willingness was payment was never been verified. And mainly for a small company, okay, this was a problem. Or a small person, this was a problem. They were never used to get a loan. Now please understand that any person who has a mobile today, okay, and the PAN number and Jan Dhan account is eligible to get a loan in next 1 hour. That was not the case before. So because of this fintech, we have seen that to do the client onboarding or underwriting, all this is not taking is taking less than a second. Not only that, even the risk profiling is also happening in no time, and the money also is dispersed in a no time. So I'll just give example how this is going to move. Just last week, I was just going through a cave and I could not find Uber Ola. My driver was on leave, so I took this Kalipili. And the driver told he was been talking on the phone on a continuous basis. So I told him, what is the problem? He was like, I will have to give 200 rupees to somebody today only. So please allow me to detour somewhere. Otherwise, tomorrow I'll have to give more. So I told him, okay, it's okay if you take 10 minutes detour. But what is this 200 rupees you are talking about? And this is where, please understand people, how this entire fintech market is going to cover. Fintech market is not for India, it is for Bharat. So please understand this subtle difference. Okay, the all fintech people are not coming to sell their product in India. Okay, they are going for all small 130 crores people who have never been able to go to bank. Coming to that example, he told me that I have taken the loan of 20,000 rupees, okay, from some travel agent, means travel agent in that sort of that hutment area, and the rule was out of 20,000 loan, 3,600 rupees was already deducted when he took the loan. So he got about 20,000 minus 3,600, so about 16,400 or some odd amount he got. And the payment terms was 200 rupees per day, okay, for 100 days. Okay, so if he pay 200 rupees for 100 days, that is a EMI repayment. And if he is unable to pay 200 rupees for any day, he will have to pay 420 rupees day after. So today, suppose I have not paid, tomorrow I will pay 200 of yesterday, 200 of today, and 20 rupees more. Okay, and this to save 20 rupees, he was rushing to pay the 200 rupees, which has to be paid on daily. So I am not counting interest on interest. I am not counting that 18%, the 3,600 which was deducted upfront. But if you count, friend, the loan, the interest on this 20,000 loan which this taxiwala got will work out to be about 76 to 80%. Okay, not 12%. Now, what this fintech will do? Fintech will very smartly will go to this taxiwala union and say, okay, we are going to give you loan at 24%. Tomorrow, if you want 20,000 rupees, don't go to this agent, anybody. Come to our site, and we will give you the loan. So instead of 20,000, first deduction of 3,600, we will deduct only 2,000. So that is first thing. So you will get 18,000 in the end. After that, you pay only 100 rupees to me, okay, for next 200, 300 days. So basically, they will work out the interest of 24 to 30%, which this guy was paying at at 70 or 80%. So what they are doing, all fintech players are wherever the market immaturity or inefficiencies are there, they are just bridging those gaps. So you should not be surprised, and I am also not surprised that some application will come only for taxi drivers. They can borrow, and I'm sure there are some app which is privately running, but this large player will come for the app for this Thelawala or Taxiwala, where they will pay 30% interest. So they borrow at 12%, and they will give the loan to this person at 30%, 35%. And we should not be surprised. Even Ola, Uber will start and connect with some fintech that all my drivers you give the loan like this. Okay, so why they should borrow at 80%? So what I want to tell you, friends, the entire fintech is a big disruptor. But I am not telling is a disruptor or innovator. So people say fintech is a disruption. We will debate, some point of time is a innovation or disruption. Okay, but the whole point is the entire inefficiency of the market will be bridged by fintech, and it has a like farm. You see Farm Easy, and there are so many 1 gram, 2 gram, I don't know, 1 mg, 2 mg. There are so many portals which is giving you the discount at 25% on your medicine, and also delivered at 1 hour, 2 hour at your home. All the intermediaries are out. But I think India is not still prepared for this type of thing, to my understanding. What intermediary will do? I always used to tell that if I want to buy the medicine, I'll get out of my house, I'll go in the elevator, I'll give something to my security, I'll take a auto, I'll go to the medical store, I will meet the salesperson. He is also been working. He will give me the medicine. I'll come by auto. Now all this has been avoided or eliminated in the system. So we will find the entire fintech, it can bring lots of absolute poverty in time to come. Okay, because there is a direct last mile connectivity between the manufacturer and the consumer. So one will have to see that all the now coming to the fintech in the financial or NBFC, lots of fintechs are getting mushroom nowadays to give the loan. And just you type on Google Play Store, you'll find 25 applications today only. Okay, Indian applications which is giving you the loan. Only one thing I would like to tell you here that RBI has come out now little bit more on a regulatory side. RBI is in December, I think November 21, has come out with a discussion paper on digital lending platform. The paper, the entire discussion paper goes, the volume is about 150 pages. Okay, so we'll have to see, and you will see that all the platforms, so RBI is concerned that who is lending, is NBFC lending or platform is lending, and who are the all stakeholders. So we will cover in some of the slide, but we will very soon find that these platforms also get regulated. So these are something about the fintech, and as I told you, fintech is going to flourish because everybody want everything, with comfort at speed. That is where fintech is playing the role. And lastly, uh, fintech means all technologies are more intelligent than the human being, more speedy, more cost efficient, and good connectivity. This all is bringing the fintech, uh, as a different element in the entire ecosystem. Kunal, you want to discuss something more on a fintech? Then we can discuss in 2-3 slides.
Yeah, so I will just run through, as Bhavesh Bhai rightly said, that fintech is a disruptor, but it is also essential to highlight that fintech is not something that is new. When in 1998, a company called PayPal initially started using internet to process payments, is when fintech was working. The day when banks started using credit cards in say 1970s and 80s, of course back then they were physical credit cards, is when fintech started. So fintech by nature is nothing but automation of financial processes and removing the inefficiencies that exist in the entire ecosystem. Uh, Running past what the scenario has been in India, and of course, Bhavesh Bhai has touched a lot of aspects about that, is the fintech's ecosystem in India is the third largest in the world with market size of $31 billion in 2021. The next 5 years, it is expected to grow at a CAGR of 22%. Another important point is that digital payments and digital lending are two of the highest are two of the biggest receivers of funding from investors, with digital payments having 43 rounds and digital lending having 62 rounds each, raising almost $1 billion to 75% or 75 or $750 million. Another important fact is the SME segment. Now, there has been a boom in the fintech lending space where all the fintech players are focusing on the SME segment only and only because of the reason that 20% of the SMEs have credit access and 80% don't. So that is why I think so. That is where I think so. The industry is heading. Distribution of fintech in terms of numbers, I think so, is self-explanatory. Moving to how the financing and NBFCs, and for that matter, even RBI and fintechs, interplay with each other. And Bhavesh Bhai gently touched upon this, is that on the regulatory front of it, the regulators, whether it is RBI, SEBI, they have set up a regulatory sandbox. Digital lending has been growing at 33.5% of CAGR and is expected to grow at that rate. what we are now observing is that banks also, the big behemoths of the financial services system, have also started digitizing their journeys, right from credit card applications to video KYC to digital onboarding. It has also led to loan sourcing. Now NBFCs are also permitted to register with the UIDAI and start conduct eKYC digitally using an OTP or a VSIP. And of course, there are peer-to-peer lending and digital banking units. Digital banking units is a good step that I think is going to create, if not disrupt, create a parallel system of banking in India, which may act as a threat to the NBFC as an industry, because the whole purpose why NBFC exists is because banks cannot serve all the customers. But if digital banking units come into the play, where something of a large bank starts providing the same services at the tap of a button, then I think so the future of this industry needs to be revisited, at least from the perspective of staying cost competitive, given the higher cost of funding that NBFCs have to suffer. What future we can expect because of the fintech is now that the journeys have been made digital, underwriting has now expected to be AI driven. What we are also expecting is that uh, a lot of synergies in terms of cost and processing and documentation, which is ultimately trickle down to the cost of funds for the borrowers. Bhavesh Bhai touched upon the future of the fintech as well, where how getting the fintech as a platform or as a service in any stream of processes is going to not only reduce cost but also increase quality. And another important thing is that these startups, although small, are very important because large institutions like banks and NBFCs, large NBFCs are not really the breeding grounds for the best of the ideas in terms of innovation, because of the time and the effort and the capital investment it takes for them to move from standard A to standard B. That is why startups give you a sort of a innovation hub or an incubation center of sorts for new innovation in the financial services sector. Uh, so as I said, the fintech has moved as an industry way from 1970s and 80s to the days of internet to now digitizing all the physical journeys, and slowly probably moving to AI driven underwriting, which is dynamic based on social score. As Bhavesh Bhai rightly said, that there is a possibility that we move to a social scoring system where your Instagram or your Facebook is or that data is assessed and you are given points on the basis of your willingness to repay, and assessed on that basis and provided sanction for a loan. With that, I think so we move to a very important aspect of things about NBFC and fintech, more specifically towards the NBFC that relate to us friends as auditors, which is pertaining to the audit and auditors. Bhavesh Bhai, if we can quickly run through the audit and auditors part of it. I think only we can go through the.
So friend, I will take the final part, and then there are some questions, about 8 questions we can see on the site. About whatever thing you want to ask. Of course, fintech is something very, very interesting. So I'm sure many of you would like to hear more about the fintech. But it is emerging, and SEBI and RBI both have been working extensively to come out, with some regulations which can really capture the platform. And see, let us understand how before I go to the accounting part, that there are 3 players in entire NBFCs in fintech space. Number 1, the NBFC itself, who are regulated. Number 2, the service providers or the who are the distributors or on the site. And number 3 is the platform itself. So RBI is of the opinion that whenever they want to work on a fintech platform, they will see whether the lending has been done through the balance sheet of the NBFC or not. Okay, I think that is going to be the key factor for RBI. If you see the paper, RBI has very categorically stated that we are going to see whether the lending has been done from the book of NBFC or not, or the platforms are not allowed to lend. So I think that is one will have to understand. RBI also has prescribed some of the measures which are on near term, mid-term and a long-term basis. So we'll have to really see. But one thing is very clear: RBI also is, aware that because of fintech, the small NBFCs should not go out of the business. So this is where RBI want, technology neutrality or a principle-based regulations. That it should not happen that only the technology-based NBFC can flourish, and others who cannot afford technology, they will not able to flourish. So RBI want to come out with a balanced approach. But I think it's going to be very, very interesting. Any of you who would like to really start, on a fintech consulting, I think is going to be very, very interesting space in time to come. Now coming to the last part, which is and I'm sure when the audit part comes, it brings the smile on the face of, I don't know whether smile or a frown, but it definitely brings smile on the face of the auditors here. Let me just tell you, when you talk about the statutory audit of any NBFC or a CIC or a housing finance company, we will have to really understand here that how many elements are touching me before I do the audit. It is not very easy that you tell your junior chartered accountant or your audit staff to really go to the NBFC audit. So you have to understand the Companies Act is, of course, the sacrosanct under which the company takes birth. That is one thing which one will have to see. Our CA Act, the standard of auditing. So all the standard of auditing, including SQC1, everything will be equally applicable when you are doing the audit of any NBFC or a CIC. So all up to SA 200 to SA 706 or whatever number, accounting standard, Ind AS, and all relevant guidance note will be applicable. There is one old guidance note, friends, of audit of NBFC which has been issued by Institute, okay, which very old. So anybody who really want to understand, they can definitely go through those guidance note. And there are even the CA final curriculum also. There are lots of material now on NBFC which one can go through for a basic understanding on NBFC. Now the questions were coming earlier that okay, where I am governed by RBI or whether at all I am governed by RBI. So earlier many companies, I don't know whether you are aware or not, maybe in 2016, 17 or 18, many chartered accountants got notices that you have not audited them correctly and why action cannot be taken against you, or please give the reply. And that time the question came from many CA fraternity that whether we are governed by RBI or we are not governed by RBI. But let me tell you, friend, Chapter 3B of RBI Act specifically talks about the auditor, and there's separate directions for the auditor also in RBI Act. So any of you who are the auditors of NBFCs or CIC will have to go through Chapter 3B requirement, okay, and you cannot just go through Companies Act or a institute standard of auditing. This also you should know. Apart from that, and which is very, very important, that if I am the auditor of NBFC, and we'll definitely discuss about, there is a separate directions of Reserve Bank of India only for auditors of NBFC, which is a direction 2016. That also one will have to really refer to, because we have been doing the audit, but for issuing the report, we have to follow even the 2016 directions. Next, as we have been talking about this, scale-based approach, and also about the auditor. I don't know whether you are aware. Last year, more or less on a similar time, okay, April, May, June, where lots of firms, including big firms and the big foreign firms, big Indian firms, they were running here and there. Because lots of changes came for change of auditors, okay, who are for the auditing of NBFCs. which is more than 1,000 crore size, and we will discuss that part also. Because RBI suddenly came out with some restrictions like banks on the auditors of NBFC, which first time came in the last year, 27 April 21. And if you remember, I told you why we were discussing the scale-based regulations, that the entire NBFC regime is moving towards the banking regulation regime, and the entire audit of NBFC also is moving to audit of a banks. And if you see the circular of 27 April 2021 is been circular for the banks and NBFC both. So first time you find that the circular which are applicable to banks will also be applicable to me as an NBFC auditor. And this please take as a word of caution to all auditors. Please be, because now we should not be surprised that RBI is going to ask you also as auditor for any lapse in reporting which happens. And of course, apart from them, last is there are lots of RBI notification and specific instruction on a theme base. Supposing you are giving a loan against gold, you are giving loan against shares, okay, or you are doing some microfinancing, or means your client is doing some micro lending, or a factoring, or maybe issuing credit cards, or infrastructure debts. There are lots of things. There are specific. They have restructured the loan sometime. So there are specific instructions for every operational aspect of NBFC, which as an auditor also you are supposed to know once you really go through the balance sheet. Can we go to the next slide? Okay. So now see friends, in CARO 2020, as you know, that out of 21 clauses, okay, which CARO 2020 encompasses, 4 clauses are for you say for NBFC and CIC, and you will be surprised that now I have to report not only for NBFC, for company which are doing NBFC activity. Earlier, what used to happen? So let me just take back you to the auditor direction of RBI. Now, auditor direction of RBI state that if you are the auditor of any NBFC, then you have to give a separate report to the board of directors of the NBFC. Listen this carefully, stating that whether they have fulfilled all the conditions of NBFC, and if there is some violations, then you have to write to RBI separately as an auditor. And this RBI has been, in many meetings, been telling that we are not getting the report. Even there are violations, auditor has not, reported the violations. Neither many times we have seen auditors are not putting the report to the board of directors when accounts get adopted. So this is for the NBFCs which has got the license. Now there are 3 parts. If NBFC has got a license, whether they are doing the compliance as mandated by RBI. If NBFC has got a license, are they doing other activity other than NBFC, and they are not required to do NBFC at all? So we have cases where there were old NBFCs, auditor were doing, and slowly the promoter moved out of financial activity to a real estate activity, but they were still holding the NBFC license. Now here also auditors are required to write to board of directors as exception report, and also to Reserve Bank of India, that look, this company which I am auditing is a registered NBFC, but the activity which they are doing is not a financial activity, because more than 50% of the asset or income is coming from a non-financial asset. Now this also is required to be reported. Third and very important part which is required to be reported is about the NBFCs, company which are not registered in NBFC, and they are doing the NBFC activity. Now this was earlier, this is from 2006, friends, you have to report. Okay, 2007 you have to report when the auditor direction came. Now people or auditors communities was aware of the opinion that only if I am doing the audit of NBFC, I have to report. The rule says when any company, underline the word company, doing any activity of loans or investment, and the asset and income is more than 50%, and if they are not holding the NBFC certificate, then auditor will have to give the exception report to the company, and they also will have to write to the to the RBI separately. So we used to say they are deemed NBFC like that. Now what used to happen? there are many companies which were doing the investment activity with their own fund or investment and loan activities, and the auditors, and they were not registered as NBFC. In many cases, the exception report were not been filed, and RBI was writing to institute. Institute was writing, through a mailer or through a circulation or a notification, please report if at all. But unfortunately, now it has come as a point of Caro. So if you read, point of Caro, I think the point number 16, which says whether company is required to be registered under 45 IA of Reserve Bank of India, and if so, whether registration has been obtained or not. Okay, and the B part of that is whether company has conducted any non-financial activity, and if yes, whether they have the certificate of registration from Reserve Bank of India or not. So these are the two things, friend, which have been part of the auditor directions from 2007, has now come as a Caro reporting. And surprising, as I was again telling you, that there are about 9,000 odd registered NBFC, and there are about 14 lakhs registered company. But for all 14 lakhs company, or wherever this Caro of course is applicable, you will have to report yes or no. So now every auditor will have to understand this. And the Caro does not stop only on NBFC. Even for CIC also, you will have to report. And it says whether company is a core investment company, and if so, whether it continues to fulfill criteria of CIC in case of companies exempted or registered as a CIC. So this is very important. Supposing you are doing the audit of some company who have invested in the group company of say 400 crores, and they are not borrowed. So technically last year they were, or the year prior to that, they were, sort of unregulated CICs. Now last year they have borrowed say 10 crores for whatever reason. So from unregulated, they are required to be registered. So every time you will have to see a CIC balance sheet also as a part of Caro reporting. So please understand the 4 new clauses out of 21 which has been added in Caro are only pertaining to CICs and NBFC. The third point, of course, is statutory auditors report to the board, which I discussed that as auditor I have to give a separate report to board. And when you give a separate report to board, please don't forget to chart separately, because it is not a report, as an auditor report under Companies Act. It is a separate report under RBI Act, which you are supposed to give. Of course, half yearly FDI certificate, which is also required to be given. There is another certificate of fit and proper criteria, which has recently come, that last year the company and the management of the company were, in last 5 years, they all been having this fit and proper criteria on a continuous basis. Okay, and this is very important. And so one auditor will also have to go, for this fit and proper criteria. As on today, friends, it is for above 500 crore size. But it may happen that tomorrow it can bring for all the auditors. Now, I really don't understand why auditor will have to really think that, whether promoters will have a fit and proper, whether. So now, if we are doing the audit of any NBFC, please incorporate in your checklist only all these points. Otherwise, let me tell you, this fit and proper criteria, at least for the last year, for the company having more than 500 crore SSIs, is bound to be forgotten and will not be reported as an exception report. Of course, there is another certificate which is known as DSBS 10. I don't know many of whomsoever doing the audit of this, NBFC. The certificate itself is like writing the entire Ramayana and Mahabharata for the company, which goes beyond the scope of your audit. And let me also tell you, friends, when you give DNBS 10, you have to certify something apart from financial data. So when you are taking the audit of a NBFC and you want to quote your fee, please examine that you don't misquote or quote low fees, because as an auditor, you don't have to cover only the Caro or the auditing or accounting standard. You also will have to cover the prudential norms, FDI certificate, fit and proper criteria, the statutory auditor certificate, separate reporting to the board, DSBS 10, all put together is a service of a statutory auditor to NBFC and not only audit under 143, friends. So please be very careful when you accept the audit assignment of any of the NBFC, which is likely to come. Okay, and why I will tell you. Go to next slide, Kunal. See now, the last, as I was telling you in 21, the new auditors requirement, the circular came from RBI, which was April 27, 2021. The new circular came from RBI, which was only for auditors of banks and NBFC. Now this circular says that if, of course, if the asset size is more than 15,000, then minimum two auditors are required. One very important part of the circular is the appointment, will not be more than 3 years. Under LODR, under Companies Act, the auditor can be appointed for 2 terms of 5 years. Okay, though SQC talks about 7 years, I am not discussing that, but auditor can be appointed for more than 5 years for 2 terms. Understand, RBI is very have a restrictive covenant. RBI says no auditor will be appointed more than 3 years for that asset size. So you will have to go through this circular very thoroughly. So what will happen that, and after 3 years, you don't have only 3 years cooling, friends. You have 6-year cooling. So you will find suddenly from 22, 23 and 24, suddenly after 2-3 years, you find lots of audit will get open to you for next 3 years or 4 years. So, and I think many has seized the opportunity also, when the rotation came. There is a concept of rotation. Apart from that, RBI also has told that even your network firm also cannot be considered for this, for the reappointment. So I think these are all welcome feature by RBI. But one will have to really go through this circular very well. This will open up lots of responsibility apart from lots of opportunity. And when I'm discussing about responsibility, RBI is not stopped about 3 years or 5 years, friends. And note of RBI is also given in the circular that if you are, there has to be minimum partner, there has to be minimum 3 partners. That out of 3 partners, 1 or 2 partners should be there for minimum 3 years. There has to be audit experience with a firm which is more than 3 years. There has to be professional staff, which 4 number, 5 number. Okay, what is the professional staff? That also has been defined. All that, minimum staff, minimum partner limits, number of year limits, all that has been defined in the circular. Very rarely, friends, you see this type of circular where audit firm is not selected based on the standing of the audit firm. Audit firm is selected based on the number of partners, number of years the partners are partner with the firms, number of professional staff, and number of years of audit experience with the audit firm. So I think this is something which one will have to understand. Very finely, very nicely articulated by RBI on the entire piece of appointment of the auditor. So that one will have to be very careful. But as I told you, we can go to the next slide. As I told you, friends, that if you are likely to get appointed from the auditor, please understand all your obligations before you accept the audit, and please also go through the Auditor Direction 2016 and also the circular of April 21 for auditor before you go. Now we will have 1 or 2 slides on risk-based internal audit, which is Kunal, if you can just take 1 minute on this, and then we can go for question answer.
So risk-based internal audit is basically applicable for NBFCs that are over 5,000 crores, non-deposit taking. And of course, then there are deposit taking NBFCs for whom they are applicable. Basically, what RBI is saying is it is bringing the audit mechanism or the internal audit mechanism that exists in banks in the NBFC spectrum, of course, large NBFC spectrum that comes into picture. What it also prescribes the authority, the stature, independence, resources, how the staff is supposed to be appointed, how much staff can be appointed from within the operational aspects of the organization, what is going to be the reporting line, how is the remuneration going to be decided, how are they going to be independent from the existing business entities, and apart from this, a detailed mechanism of risk identification, risk assessment. On the basis of risk assessment, what weightage are you going to give as internal audit? What is the frequency, which quarter or which month, whether that will be part of concurrent or whether that will be taken on a yearly basis. All those assessments have to be done as an internal auditor now of such NBFCs that are 5,000 crore plus. Although most of the NBFCs are not required to comply with this requirements, but I think as part of internal audit now, RBI intends to move from transaction specific checking to controls, governance, and compliance based checking. Is that, I think so, that is where it is moving towards. Apart from that, I think so, I'll broadly cover the penal provisions that are existing under the RBI Act, which I think so is self-explanatory. And with that, I'll request Bhavesh bhai. So I think so we'll
Yeah, so
go
friends, I
ahead
think
with-
we should now, can we go Sarath bhai with the questions? Sir? We have 5-7 minutes.
Yeah, sure, Bhavesh bhai and Kunal, very educative presentation as well as making our knowledge update on the subject. Now I'll request Shreyans to
Sure.
go through the questions.
Sure. Sir, would you like to read out by yourself or should I read it out for you? However,
No,
you-
no, I will. We will read out. Thank you. 1 minute.
Yeah.
You go. You want to go to LIFO or FIFO?
As you are comfortable, sir.
Okay.
Whatever you are comfortable with.
No, I don't know whether FIFO people is still there or they have left. That's why.
So they are still there. They are waiting for the answers.
Okay. Me and Kunal will just
So-
attempt to answer.
Yeah, so some questions are in Q&A and some questions still are there on chat box. So first you cover up Q&A, then chat box.
Yeah, I think I understood.
Yeah.
Now here, I think the answer question number first, which I can see, if RBI giving license to such companies, I don't understand which companies we are talking. So Avinash Ravani, such company means which company? So I think now
Sir, we
second
can
question
take-
will take.
I think we let us take only the straightforward questions. This type of questions we can ignore, I think.
Correct.
No, what you're saying?
No. Non-clear questions we can ignore. We can take the self-explanatory questions.
Am I audible, Vishal?
Yeah.
Sir? Okay, then I'll read out the questions and we can finish it. Second is Bhupendra Bhai. Partnership firm does not investment in shares and does investment in shares and securities activities from a capital received from partners, whether it amounts to be NBFC, even though no borrowed fund used. So partnership firm answer will be no. So you are good to go, good planning. So go ahead. Then the question of will be available, which Sarath Bhai, Shreyas and Vishal will answer. Okay. We already given, we will give it to the organizer and then you can decide. Okay. What is the view on unrealized gains and fair value gains companies following Ind-AS to be considered as financial income for the purpose of 50%? My mind, yes, Kunal, you would like to answer this?
Yeah. So for RBI, it has been clearly stated that all the regulatory positions are to be taken at India's level. So if it is hitting the profit and loss statement, it has to be considered, irrespective of whether it is unrealized or not. Then I think so. The next question is so based on discussion, entity other than corporate entity cannot do financial business. So financial business, I'm assuming by that you mean loans and advances. Mr. Kushal Mehta has said. Now that is allowed for partnership firms, proprietorship firms. Lending business is allowed in proprietorship and partnership, subject to you having a money lending license. LLP is a dicey subject. It is a body corporate in the garb of a partnership, so that's a debatable topic. But yeah, I mean, there's no restriction as such, provided you have all the regulatory licenses. But if you're a company doing financial business, then you have to have RBI license or some other license which gives you an exemption from RBI. Moving next is to an NBFC to be qualified as SI of whether total of all assets of a group company to be added, all assets of group NBFCs or group CICs to be added, not all NBFCs, not all group companies to be added. Companies not satisfying CIC criteria but investing in subsidiary company become NBFC. Yes, dear Kushal, companies that do not fulfill CIC but invest in subsidiary become NBFC provided they meet the 50-50 criteria, the principal business criteria. Bhavesh bhai, the one next one, the platform on which lending is done by others and not platform owner or operator, whether that platform owner / operator is governed by NBFC regulation.
Which is question 1, MEHTA.
637 P.
630, okay. Platform which lending is done by others and not platform owner or operator, whether that platform owner or operator is governed by NBFC. I already discussed, friend Kusal, that platform today is not regulated, and today it is the registered NBFC's prerogative and obligation to see that there are not misusing of the platform. So platform on which lending is done by other. Now this other has to be NBFC, please be very clear. Okay. Of course, platform cannot do the lending by itself, nor by any operator. So as on today, platforms are not being governed by NBFC, but the loan or the lending has to be done by the regulated entity. So, and which very soon you will find the platform also may be regulated, maybe not very far. Then the next question 643, with when Fintech company providing FLDG, okay, credit enhancement, will they have to register with RBI or not? Now, friend, FLDG is first loss, default guarantee. So when Fintech company providing FLDG, credit enhancement, will they have to register with RBI? I think which we'll have to examine. I don't have the answer as on now. To my understanding, it is like a distributor. So they may not be required, for FLDG because they are just a distributor. Earlier days also, when somebody was to distribute my loan, okay, they were not been, required to be, to be really registered with them. And next question is limit of 1,000 crore, Ashwin bhai, for appointment auditor is qua group or a qua company. Now, to my understanding, it is a qua company because if you see the directions, nowhere there is a group which is mentioned. But good question. We will also go through line by line, Ashwin bhai. But I have not seen. If you see the, I have not seen that it is a qua group. Okay. Next point is okay. This is a new point which has come now. April 21 circular NBFC. Yeah, I think somebody's. I think mic is on. So if somebody mute, some panelist. So next question, Himesh by Lakhani asked about 5 years. Does I answer will be yes, Himesh by, because if you see the circular, even if you are appointed for 5 years, you'll have to give the eligibility as per B criteria irrespective. Shall we go now to the chat box, Sarath bhai?
One question left, I think the first question.
So there is one more question on the top.
Okay, 1 minute, let me see. Where is what is the time?
Let me read out to you. I will read out to you. Can someone form an LLP and contribute funds as partners in which they are used to purchase equity shares as an investment? Is it necessary to have RBI or SEBI permission to do such a thing?
No, so let me answer that. If you go to ROC for getting, because LLP, they say is a, corporate entity. And if LLP is trying to do something, ROC itself is not going to give you the registration when you have the object clause of making investment in shares and security. So avoid that planning here.
Sir, but if in main object,
yeah,
you mention other business, means a business of professional fees or something, and then in subsequent other object we mention as investment in shares, then it will be allowed, or we need to
see. So many are doing the same thing what you said, but now whatever has happened to corporate 4-5 years back, very soon it will happen to such LLP also.
Okay.
Okay, so exactly people did the same thing when they they were doing some manufacturing company and they started building up the financial business. What RBI did, RBI took the data from MCA and sent the notice to everybody. So very soon you'll file for LLP. So avoid that structures.
No, but sir, in this question, means only part we are taking.
So next question, is there any question now?
Bhavesh bhai. Hello. Bhavesh bhai.
Bharat bhai?
Yeah, just there's one question from my side. Whether a private limited company, if it becomes a partner in another firm, and if it is investing fund into that partnership firm as a capital, and it has got no other assets, on an income side only share of profit from the firm, whether can it be considered as an NBFC?
Oh, that is a very, very technical question. Let me ask you one more question. What partnership firm is doing?
Partnership firm is doing business, regular business.
Nah?
Trading
business
business,
of what?
trading business, trading and manufacturing both.
Yeah, so yeah. So then it is exempt, so no worry. So when you are holding, the company is having a partner investment as a partner in partnership firm. Partnership firm is doing his trading and manufacturing. You will not be required to report this company as a deemed NBFC, Sarat bhai.
Okay.
Very clear.
Yeah, thank you.
So friends, with this, I think, thank you everybody on my behalf and of course on behalf of KUNAL. We like to thank the entire Borivali study circle, all the participants. In the given time, I think KUNAL played more inning than me, but we discussed about the introduction part, what are the NBFC, some preliminary part. If your registration, what are the problem? Change of control, what are the problem? What are the recent big amendment, which is a path-breaking amendment? What are the key amendments or compliance aspects? How the fintech is going to be regulated, if at all regulated? What are the fintech? What are these risk-based internal audit? And what are these auditors' directions? And then the question answer. So in the given time, the time, of course, which is now 3 hours, 15 minutes, Vishal, which is more than 2 Netflix movie. Okay. So we have to tips of that everything. So thank you so much. If there is any questions, then we can later on, you can just send to the study circle. I have no issues. So from my side, namaste and thank you so much to everybody. And I'm sure Kunal from your side also.
Yeah, just 2 minutes, Bhavesh bhai. Kunal, do you want to say anything?
No, I think so. It was an amazing experience from speaking about the topic that we love, and that is so dear to our hearts. Not only because of the love for the NBFC space, but also the fact that this is something that we are speaking on behalf of as a chartered accountant to our professional brothers, helping the industry move forward. So this opportunity is always a welcome on my front, and highly appreciate this opportunity. Thank you everybody. Thank you.
Thanks a lot, Bhavesh bhai and Kunal, for such a nice and lucid presentation. I'll request now Shreyans to offer a well-deserved vote of thanks for me.
Thank you, Sharat bhai. Friends, as we all know, finance has been a very critical part of our lives all along, be it be personal finance or commercial finance or dealing with financial institutions like banks or other organizations. The finance industry has over time evolved immensely, and so has the regulations monitoring the process. So right from traditional banks to the era of NBFC and now new age era coming up with fintechs. So we are looking forward to very challenging as well as very interesting times. Both the speakers have very meticulously helped us understand the regulations and amendments covering NBFCs and fintech. So I, on behalf of BCSC, request all the participants to carry out a well-deserved vote of thanks for both. Thank you, sir, for your guidance today. So we will end the session.
Thank you, everybody.
Thanks a lot.
Thank you, Bhavesh bhai. Thank you, Kunal.
Thank you, Sarat bhai,
Bye.
Vishal, Shreyas, Aman.
Bye, Kunal.
Thank you, everyone. Thank you.
We will end the session.
We'll end this.